Hello, hi guys. This is CA Balakrishna from Lecturepedia.in. How are you? Hope you people are doing well. Even I am fantastic. Institute has issued a new study material with respect to CA final audit that is applicable for May 2025 examinations. In that new study material, there are some amendments that have been made. So in the today's class, we'll be discussing all these amendments that the institute has brought in the new study material that is applicable for May 2025 examination. Okay, and the students who have purchased my audit concise book, which is concept book for audit, who have purchased that audit concise book, if you have purchased third edition, if you have purchased third edition of audit concise, you have to refer this amendment PDF. Okay, along with my audit concise book, you have to refer this amendment PDF. If in case you have purchased fourth edition of audit concise book, you need not refer this amendment PDF. Okay, in the fourth edition of audit concise book, all these amendments have already been introduced. Okay, I have already made all the amendments in the fourth edition of CA final audit concise book. Hope that is clear. And this amendment PDF I will be sharing in the Telegram channel, and I will also be sharing this amendment PDF in the, I will be giving a link to this PDF in the description of the video. Okay, from those places you can access this amendment PDF, and you can also access this amendment PDF from our app. Okay, we have launched Lecturepedia app, right? So basically in that Lecturepedia app, you can solve MCQs. Okay, MCQs of all the subjects you can solve for free of cost, and you can also purchase courses of various faculties from our app. You can download our app from Play Store. Okay, you can just check out our app. So now, before starting, I'll just give you a brief idea of what are the amendments that has come. If you see, the first amendment is SA 450. The text of SA 450 has been given. Previously, in the previous study material of the institute, they have missed the entire SA 450 text, which is evaluation of misstatements identified during the audit. Misstatements. Just a second. Identified during the audit. So this is the first amendment that is given. Next, SA 800 series, specialized areas. All the three standards, SA 800, SA 805 and SA 810. There are amendments in these three standards. You can say the amendments of these three standards are not so major amendments. Okay, the basic concept of these standards is as it is. Okay, there is no change in the basic understanding, basic concept of these standards, but some additions or some additional explanation has been introduced with respect to these three standards, because if you see, institute has also given revised SA 800 series. Okay, based on that SA 800 series, the changes have been made in our study material. Okay, so the second amendment will be with respect to this area, SA 800 series. Next, third amendment is with respect to audit of NBFCs. There is some major amendment in this audit of NBFCs, and the fourth amendment is in audit of banks. In audit of banks, the amendment, it is not a major amendment, just some general points have been added. And finally, in professional ethics, the guidelines with respect to new CA logo has been introduced. You already know, right? Uh, New CA logo has been launched, which is a tricolor CA logo. Okay, tricolor CA India logo. So, with respect to this, the guidelines are given in our study material. So, these are the 5 areas in which amendments has come. We will be discussing all these in this lecture. Okay, let us first of all start with essay 450. Here you can find I have given the index, the 5 areas of amendments. SA 450 completely, the complete text of SA 450 has been newly introduced, and SA 800, 805, 810, the amendments what I have done is with respect to this SA 800, 805 and 810, I have given entire text of 800, 805 and 810. Okay, the entire text I have given. In that entire text, the amended portion I have highlighted in the green. Okay, so amended text will be highlighted in the green. And audit of NBFC also, the amended text I have highlighted in the green. Okay, whatever the content that you will find in this PDF in green color, that is amended portion. Okay, same with audit of banks and same with professional ethics. Hope that is clear. So essay 450. Now this SA 450 we have already discussed in our regular class. Okay, even though the text is not given in the study material, in order to understand the concept in our regular class we have discussed this SA 450 along with SA 315, 330 and 450. Basically these standards are interlinked. As per SA 315, auditor has to identify and assess risk of material misstatements. How auditor will identify and assess the risk of material misstatement? By understanding the entity and its environment, right? So as per SA 315, auditor will identify the risk areas. Okay, where the material misstatement can occur, where there is a risk of material misstatement, those areas will be identified as per SA 315. After identifying those risk areas, auditor as per SA 330 will perform audit procedures, right? Auditors responses to assess the risk of material misstatements, that would be the name of this standard. So as per SA 330, auditor will give his responses to assess the risk. Where he has assessed the risk? In SA 315, auditor has assessed the risk. Responses means nothing but he will perform audit procedures. Okay, by performing audit procedures, auditor will respond to the risk. Now once auditor performs the audit procedures, while performing those audit procedures, auditor will identify various misstatements, right? While performing audit procedures, By performing audit procedures, auditor will identify misstatements, right? By applying SA 320, auditor will decide whether these misstatements are material or not, right? SA 320 deals with materiality. Now, after auditor has identified the misstatements, what the auditor will do? Auditor has to evaluate misstatements identified during the audit. This is nothing but SA 450. Okay, so how auditor will evaluate the misstatements identified during the audit, that we will be discussing in SA 450. Hope this is clear. Now let's start with SA 450. I hope you understood the background. I just given you a brief. Now SA 450 deals with auditor's responsibility to evaluate effect of identified misstatements during the audit. Definitions. Definition of misstatement. I need not explain the definition of misstatement, you already know. Amount to, if there is a difference between the amount, classification, presentation, disclosure that has been made by the management in the financial statements, and the amount, presentation, disclosure that is the required as per the applicable financial reporting framework, then you will call it as misstatement. Okay, if the ACPD means amount to classification, presentation, disclosure. ACPD that has been made by the management in the financial statements is not as per the ACPD that is required as per the applicable financial reporting framework, then you will call it as a misstatement, right? Simple. Now, if that misstatement is not corrected by the management, then you will call it as uncorrected misstatement, right? Next, factual misstatement means 100% it is a misstatement. Okay, there is no doubt that it is not a misstatement. Okay, 100% sure that is it is a misstatement. It will be known as factual misstatement. Okay, there is no doubt regarding it. Okay, it is 100% misstatement. Okay, that is known as factual misstatement. Next, judgmental misstatement. Okay, judgmental misstatement means misstatement with respect to the judgments that the management has taken. Let's say, for example, inventory. Management has valued inventory on a cost basis, but auditor, as per the judgment of the auditor feels that inventory has to be valued at cost or NRV, whichever is lower. So here there is a difference between the judgments. Okay, auditor, there is a difference between the judgment that the auditor has made and the judgment that the management is making. So this is a judgmental misstatement. Next, projected misstatement. What is projected misstatements? Generally, in case of, in the audit, we will use sample, right? So, out of some 1,000 population, we have selected, or out of 1,000 debtors, we have selected 100 debtors as sample. Okay. Now, in these 100 debtors, on these 100 debtors, we have applied our audit procedures, and and we have found two misstatements. Okay, so in a sample of 100 debtors, there are two misstatements. Now you will project these misstatements to the entire population. That means in sample of 100 debtors, if there are two misstatements, then in entire population of 1,000 debtors, how many misstatements will be there? 20 misstatements. You will just project. It is not 100% sure that there will be 20 misstatements only. You are just projecting, okay, based on the data that you have acquired by performing audit procedures on the sample. You are applying the same data, you are projecting the same data to the entire population. That is known as projected misstatement, right? Next, see, since these definitions you already know them, I am just giving a brief discussion of these definitions. Okay, I'm not going deeper into these definitions. Next, clearly trivial. What is meant by clearly trivial? Okay, clearly trivial misstatement means such a misstatement which is a minute misstatement which need not be considered by the auditor. Okay, such a misstatement is known as clearly trivial misstatement. Okay, those misstatement which is clearly trivial means the misstatement which is very minute, which need not be considered by the auditor. Okay, see, SA 450 requires the auditor to accumulate the misstatements identified during the audit, except for those that are clearly trivial. Okay, with respect to the generally SA 450 states that auditor has to accumulate all the misstatements and evaluate them, except clearly trivial misstatements. Why auditor need not accumulate clearly trivial misstatements? Because they are minor misstatements. Auditor need not consider those misstatements. Example, let's say for example, clearly trivial means, again there is a possibility that you might understand that clearly trivial means immaterial misstatements. No, there is a difference between immaterial misstatements and clearly trivial misstatements. See, let me just tell you. Misstatements with in the context of materiality can be of three types. Yeah, misstatements can be of three types. First one, material misstatements. Second one, immaterial misstatements. Third one, clearly trivial misstatements. Clearly trivial misstatements. Now, material misstatements means as per SA 320, auditor will set a materiality. If the misstatements cross that materiality level that has been set, then you will call it as material misstatement. If the misstatement is below that materiality, you will call it as immaterial misstatement. Now, clearly trivial means very minute misstatement which you need not consider. Example, now you have calculated depreciation. You'll apply some percentage and you'll arrive at depreciation. Now you have arrived depreciation amount as 6,842.7. Now you have rounded off this to 6,843. Okay, like this, various figures you will round up in case of financial statements. So while rounding up of various figures, a difference of some 4 rupees has arisen. Now this is a clearly trivial misstatement. Okay, this is a misstatement. Okay, if there is a difference in the value, it is a it is a misstatement, but it is clearly trivial, a very minute difference. Okay, the difference or the misstatement in decimals, which is clearly trivial. Okay, so auditor need not consider these type of misstatements. Okay, so these type of misstatements are known as clearly trivial misstatements. Hope that is clear. So these are the definitions. So you can read the text of clearly trivial misstatement. These misstatements are of such a small magnitude that they do not require further evaluation or correction by management. Importantly, trivial is not synonymous with not material. Okay, you should not assume that trivial misstatements means immaterial misstatements. No, trivial misstatements are not immaterial misstatements. A misstatement can be not material but still require evaluation, while a clearly trivial misstatement is so small that it does not warrant a further consideration. Okay, in case of if a misstatement is immaterial, even though even though it is immaterial, some immaterial misstatements might require further evaluation by the auditor. Okay, but in case of trivial misstatements, auditor need not evaluate them, auditor need not consider them. Okay, hope that is clear. Next, considerations of identified misstatements as the audit progresses. Now, while starting the audit, you will develop overall audit strategy. You will also develop audit plan, right? With the help of after developing audit strategy and audit plan, you will start the audit. Now, while doing the audit, you found some misstatements. Okay, you have found even more misstatements. Now, as the audit progresses, if you are finding more and more misstatements, then you have to evaluate whether you should change your audit strategy and audit plan to cover more areas. Okay, at the time of starting the audit, okay, at the beginning of the audit, you would have developed your audit strategy and audit plan based on a consideration that these entity might have low misstatements. Okay, because we have audited this entity in the previous year also, so based on our experience, we need not evaluate some areas in a more extensive manner, so we can just perform control testing in some areas, and for some other areas we will go for substantive testing. Like this, you would have developed some audit plan and audit strategy based on your understanding at the beginning of the audit. But as the audit progresses, you will uh, you will get additional information, you will find more misstatements. So based on that additional information and based on the misstatements that you have identified till now, you have to evaluate whether you have to change your audit plan or whether you have to change your audit strategy. So the first thing that you have to do after finding some misstatements is you have to evaluate whether you have to change your audit plan or audit strategy. See, the auditor shall determine whether overall audit strategy and audit plan need to be revised if the nature of identified misstatements and the circumstances of their occurrence indicate that other misstatements may exist that when aggregated with misstatements accumulated during the audit could be material. Okay, when auditor feels that based on the misstatements that you have identified till now, there is a possibility of some more misstatements in the financial statements. If auditor feels, and by combining those some more misstatements that might be there in the financial statements with already identified misstatements, they could be material. Okay, if auditor feels so, then auditor has to consider revising the audit plan and audit strategy to cover even all to cover more extensively and to perform substantive procedures and to change his audit procedure. Okay, to change his audit plan. So auditor needs to consider this. The aggregate of misstatements accumulated during the audit approaches materiality determined in accordance with SA 320. Okay, so in these two situations, auditor has to consider revision of audit plan and the audit strategy. What are those two situations? When auditor feels that by combining the misstatements that I have already identified and the unidentified misstatements, if I combine both of them, whether they will cross the materiality level, they are crossing the materiality level. Okay, in that first situation you have to consider revising your audit plan and audit strategy. Second situation, already identified misstatements, they themselves are crossing the materiality level. In that situation also you have to consider revising the audit plan and the audit strategy. Okay, next, if the management has corrected the misstatement, see, auditor has identified the misstatement and communicated those misstatement to the management. See, whenever auditor identifies the misstatements, he needs to communicate them to the management on a timely basis. Now, once he has communicated to the management, if management has corrected those misstatements, auditor has to again verify whether management has actually corrected those misstatements. Auditor has to again perform procedures to see whether misstatement has been properly corrected or not. See, if management has corrected misstatement that were detected, auditor shall perform additional audit procedures to determine whether misstatement remain. Okay. Next, communication and correction of misstatements. I already told you, whenever auditor identifies the misstatements, he needs to communicate them to the management on a timely basis. See, the auditor shall communicate on a timely basis all accumulated misstatements with the appropriate level of management unless prohibited by law or regulation, and shall request management to correct those misstatements. Now, if management refuses to correct those misstatements, auditor needs to consider the effect of those misstatements at the time of giving the audit opinion. Okay, he has to consider whether because of that uncorrected misstatements, whether I have to modify my audit opinion. Okay, auditor needs to consider that. If management refuses to correct the misstatements, auditor shall obtain an understanding of management's reason. Okay, before directly giving an impact on the opinion, you first of all discuss with the management and ask the management the reasons why they are not correcting, and you need to evaluate those reasons. Okay, for not making the corrections, and shall take the understanding into account when evaluating whether financial statements as a whole are free from material misstatements or not. Okay, next, evaluating the effect of uncorrected misstatements. See, prior to evaluation, the auditor shall reassess materiality determined. Okay, before evaluating the misstatements that are uncorrected, you have to once reassess the materiality that has been calculated. Okay, see, you have identified the misstatements. After identifying the misstatements, you are evaluating those misstatements, whether these are material or immaterial, and whether uncorrected misstatements will be material or they will be material. Okay, so before evaluating the misstatements that you have identified, you have to once revisit your materiality level. Okay, the materiality level I have set now at the time of beginning the audit, whether that materiality level will it remain same or do I have to revise it, you need to once reconsider that. Okay, see, in determining whether uncorrected misstatements, see, here we are discussing about uncorrected misstatements. Okay, after identifying the misstatements, see, uncorrected misstatements, they can arise in two situations. See, first of all, there are misstatements. Just a second. See, there are misstatements. Now, auditor has identified the misstatements and communicated to the management. Communicated to management. After auditor communicates to the management, management can either correct the misstatements. If management has corrected, then there is no issue. Or if management doesn't correct them, then uncorrected misstatements will be there, right? Uncorrected misstatements. Next, auditor has not at all identified that misstatement. Not identified. If you have not at all identified, how can you correct? So then also uncorrected misstatement will arise. So in these two situations, uncorrected misstatements will arise. Now you need to evaluate the effect of these uncorrected misstatements on the financial statements and on your audit. So while evaluating, see, in determining whether uncorrected misstatements are material individually or in aggregate, the auditor shall consider size and nature of the misstatements, particular circumstances of their occurrence, and the effect of uncorrected misstatements related to prior periods. Okay, now there are uncorrected misstatements. Okay, now auditor will be concerned with the misstatements only if they are material, right? If they are immaterial, auditor will not be, auditor need not consider them. Only if the misstatements are material, auditor will consider them. So auditor needs to see whether these uncorrected misstatements individually or combined together will be material or not. Okay, so for checking their materiality, auditor needs to see their materiality with the help of this. Okay, based on size and nature of the misstatement. Okay, how much amount and what is the nature. Nature means in which area that misstatement has occurred, and the particular circumstances of their occurrence. Okay, why that misstatement has occurred, and effect of uncorrected misstatement related to the prior periods. Okay, based on this you need to decide whether the uncorrected misstatements are material or not. Next, communication with those charged with governance. Obviously, you need to communicate with those charged with governance. The auditor shall communicate with those charged with governance uncorrected misstatements and their effect on the opinion in the auditor's report unless prohibited by law or regulation. Okay, auditor needs to communicate what are the uncorrected misstatements and what effect these uncorrected misstatements will have on his opinion. Next, the auditor's communication shall identify material uncorrected misstatements individually. Okay, if auditor, if there are any uncorrected misstatements that are material, then auditor needs to individually communicate these material uncorrected misstatements with those charged with governance, because auditor has asked the management to correct the misstatements, but management has not corrected and these are material. Since the management has not corrected these misstatements, if at least you communicate these misstatements to those charged with governance, there is a possibility that those charged with governance will uh, you know uh, correct those misstatements. So you have to individually communicate the material uncorrected misstatements with those charged with governance. Hope that is clear. Effect of uncorrected misstatements related to prior periods on the relevant class of transaction, account balance, disclosure, and the financial statements as a whole. Okay, if in the prior period there are misstatements, so what effect the prior period material misstatements are having in the current period? Let's say, for example, in the prior period you have capitalized a revenue item, so you have calculated depreciation on that asset. Because of capitalization of revenue item in the previous year, the misstatement has occurred in the previous year. Because of that, in the current year also you will calculate depreciation. So that amount is the effect on the current period. Okay, let's say in the previous year 1 lakh worth of revenue expenditure you have calculated, and the rate of you have capitalized in the previous year, and rate of depreciation of on further on that particular item to which you have capitalized is, let's say, 10%. So in the current year you will again calculate depreciation on that revenue item which you have capitalized. So that is a effect of the misstatement that has occurred in the previous year. That also you need to communicate with those charged with governance. Hope that is clear. Next, the auditor shall request that uncorrected misstatements be corrected. Okay, you need to request those charged with governance by giving all these uncorrected misstatements to please correct these misstatements. Okay, and finally, written representation. You need to see the auditor shall request a written representation from management and where appropriate, those charged with governance, whether they believe the effects of uncorrected misstatements are immaterial individually and aggregate to the financial statements as a whole. Okay, you need to ask a written representation from management and those charged with governance whether they believe that uncorrected misstatements are immaterial, and auditor need to document the amount below which misstatements would be regarded as clearly trivial. See, clearly trivial means auditor need not further evaluate them. All misstatements accumulated during the audit and whether they have been corrected. Okay, you need to document all the misstatements that you have identified and whether they have been corrected. The auditor's conclusion as to whether uncorrected misstatements are material individually or in aggregate and the basis for that conclusion. So these aspects you need to document. This is essay 450. Next, moving to amendment related to essay 800 series. Essay 800 series, it deals with specialized areas. In this series, we are having 3 standards, right? As I have already told you, the concept of these 3 standards has not changed. Just some additional points and some additional explanations has been introduced in the form of amendment. Okay, so this has to be kept in our mind that there is no change in the concept of these standards. The concept is intact, just some additional examples and some additional explanations, okay, has been added. Hope that is clear. Now let's see, starting with amendments of essay 800. Now essay 800, it deals with audit of financial statements prepared as per special purpose financial reporting framework. What is a special purpose financial reporting framework? So, those framework which will be used to satisfy the financial information needs of specific users is known as the special purpose financial reporting framework, whereas general purpose financial reporting framework, it will satisfy the financial information needs of all the general users. Okay, now if you see the first amendment of essay 800 series, in the examples of special purpose financial frameworks, previously the example that we would be reading is cash receipt and disbursement basis of accounting and also cash flow information that an entity may be required to prepare for the creditors. Now this has been simplified. Okay, they have removed the term receipts and disbursement. Okay, the cash basis of accounting, both are same. Okay, either you can say cash basis of accounting or cash receipts and disbursement basis of accounting, both are same. Okay, just to simplify, they have removed this term receipts and disbursement. Okay, now the example is cash basis of accounting that you will follow in case required by any specific creditor. Okay, that is the first amendment of essay 800. Next, an explanation has been given. Okay, see, let me read this explanation related to financial statements. Okay, in this essay 800 standard, wherever the term financial statement is used, you have to understand it as the complete set of financial statements prepared as per special purpose financial reporting framework, including the notes to the accounts. Okay, so wherever the term financial statements is used in this standard, essay 800 standard, you should understand it as a complete set of financial statements, okay, including the notes. That is some explanation with respect to the financial statements. See, reference to financial statements in this essay means a complete set of special purpose financial statements, including the related notes. The related notes ordinarily comprises summary of significant accounting policies and other explanatory information. The requirements of applicable financial reporting framework determine the form and content of financial statements and what constitutes a complete set of financial statements. Okay, so a small explanation about financial statements is introduced. Next, considerations in accepting such framework. There is no amendment in this point. Okay, all the points they remain same. So no amendment in consideration that has to be taken into care while accepting the financial reporting framework. Considerations when planning and performing audit. Here two points has been introduced. You can tell it as just one point. I have bifurcated into two. Okay, with respect to essay 315, let us see. Considerations when planning and performing such audit. Such audit means audit of financial statements prepared as per special purpose financial reporting framework. Okay, now while planning the special purpose financial reporting, while planning the audit of special purpose financial statements, as usual you will follow SA 300 and all other standards. As usual you will follow. Along with that, a special consideration has to be given as per SA 315. Basically, as per SA 315, in case of a general audit of general financial statements, you will understand the entity and its environment, right? As per SA 315, in understanding the entity and environment, you will understand the accounting policies that the company, that the management has followed for preparation of financial statements, right? So this understanding you will get as per SA 315 for the audit of general financial statements. Now for the audit of financial statements, okay, special purpose financial statements, sorry, that are prepared as per a specific contract. Okay, now the special purpose financial statements, they will be prepared based on special purpose financial reporting framework, and this special purpose financial reporting framework, it can be given by a authorized authority, or the special purpose financial reporting framework can be as per the contract between the parties. Let's say for example, the company has entered into a contract with the government to construct a particular project. Now in that contract, government has required the company to prepare the financial statements of the company for the purpose of submitting to the government itself as per the rules and regulations, as per the framework that is given in that respective contract. Okay, so here in this situation, if the special purpose financial statements are prepared as per the special financial reporting framework of a contract, then auditor should understand the requirements of that particular contract. Okay, auditor should get an understanding of that particular contract. Why? Because the framework as per which the financial statements are prepared is prescribed in that contract. So auditor should understand the contract. Okay, this point is introduced as an amendment. See, considerations when planning and performing the audit. As per SA 315, requires the auditor to obtain understanding of entities selection and application of accounting policies. This is for the general audit. Okay, for the statutory audit of general purpose financial statements. Whereas in case of financial statements prepared in accordance with provisions of a contract. That means special purpose financial statements. In that case, the auditor shall obtain understanding of any significant interpretations of the contract. Okay, auditor should obtain understanding of significant interpretations of that particular contract that the management made in preparation of those financial statements. Now here the question that arises is, what is meant by significant interpretations of the contract? Let me explain you the same example that we have taken. Let's say our company is A Limited. Okay, A Limited entered into a contract or agreement with government to construct a particular project, let's say a dam. Now in this contract, government has specified certain financial reporting framework. As per that financial reporting framework, A Limited has to prepare its financial statements and submit it to government. Now there is one particular point in that framework which says that revenue of A Limited should be recognized on completion of work basis. Okay, so now in order to construct the dam, it will not complete in 1 year. It will take some 5 to 6 years. Now the company has to recognize, the A Limited has to recognize the revenue on completion of work basis. Okay, this point is written in the contract. Now the company has to interpret this point. Here in contract it is just written that you have to recognize the revenue on completion of work basis. Now how much work is completed? How you will know how much work is completed? How much work is completed? How you will know how much work is completed? There are two options to know this. First one is some external engineer will certify will assess and certify. Okay, he will assess and certify completion of work. Okay, completion of work. This is the first option. Second option is internal assessment by the entity itself. Internal assessment by entity itself. Okay, entity itself will assess how much work has been completed. This is the second option. Now entity has to interpret this point to understand which one to follow. Now entity has interpreted that they will assess the completion of work internally. They will not take any external engineer's help, because no specific requirement has been given in the contract. Entity has interpreted that they can make their own internal assessment of completion of work. Okay, so here this interpretation will become significant interpretation. Okay, this type of interpretation will become Significant means important interpretation. Why this has become significant interpretation? Because instead of using internal assessment, if the entity has taken help of engineer for assessment of the completion of work, the amount of revenue would have changed. Okay, let's say company internally assessed that 20% of work is completed and they have recognized a revenue of 10 crore, let's say for example. Now if the same assessment has been done by external engineer, he would say that only 15% of work is completed and 7.5 crore revenue has to be recognized. So if they have interpreted that particular line differently, then there would have been impact on the financial statements. Since there is an impact on the financial statements because of different interpretation, such a interpretation becomes a significant interpretation. Hope this is clear. Now the standard says that auditor has to understand all the significant interpretations of the contract. Hope that is clear. Just like auditor understands the accounting policies that the management uses as per SA 315, auditor should also understand all the significant interpretations that the management has taken with respect to that particular contract. Hope this is clear. See, I'll once again read this line so that you'll understand. SA 315 requires the auditor to obtain an understanding of entity selection and application of accounting policies. In the case of financial statements prepared in accordance with the provisions of a contract, the auditor shall obtain understanding of any significant interpretations of the contract that the management made in preparation of those financial statements. Now, what is a significant interpretation? An interpretation is significant. Significant means important when adoption of another reasonable interpretation would have produced a material difference in the information presented in the financial statements. Okay, instead of making this interpretation, if the management has made this interpretation, then there would have been a difference in the amount that you will recognize in the financial statements. So this is called significant interpretation. Hope you understood this point. So this is the amendment that has been made in the considerations when planning and performing the audit. Hope that is clear. See, from now on, from 800 series onwards, wherever the text is marked in green, it has to be understood as an amendment. Okay. All the blue text and red text, it is not amended portion. That is the entire standard. Okay. And in some cases, side headings I would have underlined and marked in green. Okay, that you should not understand as an amendment. If the text is in green, you should understand it as amendment. If the side headings are green, those are not amendments. Okay. Next, description of applicable financial reporting framework. Now, here reference to two standards has been given. What are those two standards? SA 701 and SA 720. What is SA 701? SA 701 is key audit matters and SA 720 is other information. Right, auditor's responsibilities with respect to other information. What is other information? Now, financial statements, they will be presented in a particular document. You will call it as annual return. So in the annual return, apart from financial statements, every other information will be known as other information. Okay, and Key audit matters are those audit matters which the auditor considered as significant for the purpose of audit of current year. Those audit matters which the auditor has communicated to those audit with governance and auditor feels that they are significant, then they will be known as key audit matters. Now, if you see, the reference of those two standards has been given here. Basically, just like in case of audit of general purpose financial statements, auditor can give key audit matter in his audit report, right? In case of listed company, it is not, it is mandatory, whereas in case of unlisted company, it is not mandatory, but however, if auditor wants, he can give. Okay, just like auditor can give key audit matter in case of audit report of general purpose financial statements, auditor can also give key audit matter in case of audit report of special purpose financial statements. When auditor gives his key audit matter in audit report for special purpose financial statements, then SA 701 is applicable. Okay, that is the new insertion that has been made. See, this one, this point is there previously also. Okay, this understanding is there previously also, because we have discussed all the standards from SA 200 series to SA 700 series. All standards are applicable to the SA to the special purpose financial statements, right? This point we have discussed, but now specifically these two standards, applicability of these two standards has been specifically introduced into the standard itself. Okay, previously also these standards were applicable for special purpose financial statements, but now institute specifically introduced the applicability of these two standards in the text of SA 800. Okay, see, when key audit matters are communicated in the auditor's report on special purpose financial statements, SA 701 applies in its entirety. Okay, next, SA 720. SA 720 deals with auditor's responsibility relating to other information. In the context of this SA, reports accompanying the special purpose financial statements are considered to be annual reports for the purpose of SA 720, the purpose of which is to provide owners with the information and on matters presented in the special purpose financial statements. When the auditor determines that an entity plans to issue such a report, the requirement of SA 720 apply to the audit of the special purpose financial statements. Let me read this, then I'll explain you. The auditor may deem it appropriate to refer in other matter paragraph. Okay, let me explain the requirement of SA 720 first. Later on, I'll go for SA 706. Now, general purpose financial statements. Generally, entity will issue these general purpose financial statements to the stakeholders in a particular document. Okay, wherein apart from general purpose financial statements, various other information will also be present. Okay, you'll call it as annual report, right? So all this information other than general purpose financial statements is known as other information, right? So for this other information, SA 720 is applicable. As per SA 720, the crux of SA 720 is that auditor has to ensure that the other information that is presented in the document is consistent with the information that is given in the financial statements. Okay, that is the crux of SA 720. Now coming to the special purpose financial statements. Special purpose just a second. Yeah, special purpose financial statements. Now, just like general purpose financial statements will be given in a particular document, management can also decide to give special purpose financial statements in a particular document wherein apart from special purpose financial statements certain other information can also be present. Okay, so special purpose financial statements are issued as part of some other document wherein some other information is also present. So if in case management decides to issue special purpose financial statements like this, then this entire document will be considered as annual report for purpose of SA 720, and all this other information, okay, all this information contained in this document apart from special purpose financial statements will be treated as other information for the purpose of SA 720, and all the requirements of SA 720 will be applicable with respect to this other information. Okay, so this is a new amendment point that has been introduced. See, this understanding, it was there earlier also. Okay, earlier also all the standards including SA 720, SA 701, SA 706, all the standards are applicable for special purpose financial statements. Okay, we used to read it like this, but now specifically it has been introduced, the applicability of these standards. Next, now SA 706, the auditor may deem it appropriate to refer in the other matter paragraph. Other matter paragraph means what you will give in other matter paragraph. If auditor wants to communicate anything about his audit to the users, then you will give other matter paragraph, right? In the auditor's report on the special purpose financial statements, to the auditor's report on the complete set of general purpose financial statements, or to matters reported therein as per SA 706. Now, see, on general purpose financial statements, a audit report will be issued, right? Audit report will be issued. In the same way, on special purpose financial statements also, audit report will be issued. Now, if auditor of special purpose financial statements wants to refer the audit report that has been given on general purpose financial statements in his audit report, then such a reference of audit report of general purpose financial statements can be made in the other matter paragraph of this audit report. Okay, so for this other matter paragraph, SA 706 will be applicable. Hope that is clear. Here, see, for example, the auditor may consider it appropriate to refer in the auditor's report on the special purpose financial statements to a material uncertainty related to going concern section included in the auditor's report on the complete set of general purpose financial statements. Okay, in the complete set of financial statement, audit report that has been issued on the complete set of financial statements, that auditor has included a paragraph with respect to material uncertainty related to going concern. Now, this going concern aspect, it will affect the entity, right? It will affect the entity, whether it is a special purpose financial statements or it is a general purpose financial statements. The going concern matter will affect the entity. Since it will affect the entire entity, the auditor of special purpose financial statements can decide to refer that matter related to going concern which has been given in the audit report of general purpose financial statements. Okay, that matter can be referred by the auditor of special purpose financial statements in his audit report. Such reference has to be given in other matter paragraph, and for such other matter paragraph SS 706 is applicable. Hope that is clear. Next, electing the readers of the financial statements, special purpose financial statements. Now, as you already know, special purpose financial statements, they are prepared as per the special purpose financial reporting framework. So these special purpose financial statements, they can't be used by all the users. Okay, they are useful only for certain users. So auditor has to alert the users that these financial statements are prepared as per special purpose financial reporting framework. So these financial statements are not, you know, applicable for all the users, or these financial statements are not useful for all the users. Like this, the auditor has to alert the users, right? This point was there earlier also, but the way in which it will be presented has been changed. Earlier, for alerting the users with respect to this point, was using a separate paragraph stating alerting the users, right? Like this, a separate paragraph was used earlier, but now see, auditor will give this alert in the emphasis of matter paragraph itself. Okay, see, the special purpose financial statements may be used for purposes other than those for which they intended. For example, regulator may require certain entities to place the special purpose financial statements on public record. In that situation, to avoid misunderstanding, the auditor alerts users of the audit report by including an emphasis of matter paragraph. Okay, earlier also auditor used to alert the users, but not in emphasis of matter paragraph. Auditor was using a separate paragraph for alerting the users, but now in the emphasis of matter paragraph itself, auditor will give this line. Okay, alerting the users. Emphasis of matter paragraph explaining that the financial statements are prepared in accordance with a special purpose framework and therefore may not be suitable for other purpose. Hope that is clear. SS 706 requires this paragraph to be included within a separate section of auditor's report with an appropriate heading that includes the term emphasis of matter. Okay, auditor has to alert the users stating that these financial statements are prepared as per special purpose financial reporting framework, and this alert has to be given in emphasis of matter paragraph. Now, as an extension to this alert, auditor will go a step further and he will also restrict the users of the who can read this audit report or to whom this audit report can be circulated. See, restriction on distribution or use. The same discussion. Since these financial statements are special purpose financial statements, and since this audit report is audit report on special purpose financial statements, this audit report, it cannot be used by all the users, so it should not be distributed to all the users. Okay, it will be distributed only to specific users. So auditor in his audit report itself, he can restrict on distribution or use of his audit report, where this restriction on use of audit report will be written by the auditor in the same emphasis of matter paragraph as an extension to the alert that the auditor has given earlier. As an extension to that, auditor will add this matter also. Okay, again, previously this restriction on distribution or use of audit report was given in that separate paragraph that auditor was using for the alert, for alerting the users. Now since the auditor is alerting the users in emphasis of matter paragraph, in the emphasis of matter paragraph itself, auditor will also restrict the distribution of his audit report. Okay, see, in addition to the alert required as discussed above, the auditor may consider it appropriate to indicate that auditor's report is intended solely for specific users. Depending on the law or regulation applicable, this may be achieved by restricting the distribution or use of the auditor's report. In these circumstances, the paragraph alerting the readers may be expanded. Okay, the paragraph that the auditor has written to alert the users, that same paragraph will be expanded to include these other matters and heading modified accordingly. Here an example has also been given. Let's see. Example of emphasis of matter paragraph. Heading: basis of accounting. See, by using the term basis of accounting, you are alerting the user, stating that the basis of accounting that has been followed here is as per special purpose financial reporting framework. So alerting the users on basis of accounting. And restriction on distribution and use. So you are covering both these points in this paragraph. Let's see how this paragraph has been drafted. We draw attention to note number 10 of the financial statements, which describes the basis of accounting. Okay, if you go to the note number 10, there the basis of accounting will be described as this accounting. This basis of accounting is prescribed as per the special purpose financial reporting framework. The financial statements are prepared to assist the company in complying with the financial reporting provisions of the contract referred to above. As a result, the financial statements may not be suitable for other purpose. Okay, so here you are restricting. Our report is intended solely for the company and DEF Company Limited and should not be distributed to or used by parties other than the company or DEF Company Limited. Our opinion is not modified in this matter. Okay, DEF Company means the second party to the contract might be DEF Company. Okay, in the example they have considered it like that. Okay, contract has been entered between our company and DEF Company. In that, as per the framework prescribed in that contract, we have prepared these financial statements. So since we have prepared the financial statements as per that framework, these financial statements and our audit report can be used only by DEF Company and our company. So you have restricted the use of your audit report. Hope that is clear. That is essay 800. Next, essay 805. Now essay 805 deals with audit of single financial statement or specific element of a financial statement. Generally, you will audit complete set of financial statements, right? You'll audit balance sheet, profit and loss, cash flow, notes to accounts. Okay, complete set you'll audit. But there can be certain situations wherein you have to audit only a single financial statement, like only the profit and loss statement you have to audit, or only the cash flow statement you have to audit. Or there will also be situations wherein you have to audit only specific element of financial statements, like only inventory you have to audit, only debtors you have to audit, only revenue you have to audit. Okay, that is revenue audit, inventory audit. Okay, so in those situations essay 805 will be applicable. Hope that is clear. Now again, here also only the green text will be amended portion. Considerations when planning and performing the audit. Here, earlier we used to read that all the standards on audit are applicable for audit of single financial statement and audit of specific element of financial statements. Now also the same will remain. Okay, adopt all yeses, but as an example, certain specific standards has been specifically inserted in SA 805. What are they? SA 240, SA 550 and SA 570. Okay, 240 deals with fraud, 550 deals with related party, 570 deals with going concern. Okay, specifically it is said in the standard that these three standards are applicable. Okay, not only these three standards, apart from these three standards, all other standards are also applicable. If you see in the third point, SA 260 is also applicable. Okay, so just as an example, some points, some standards have been specifically introduced into the text of the standard. Okay, apart from these standards, all other standards are also applicable wherever required. See, the relevance of each of the essays require careful consideration, even when only a specific element of financial statement is a subject of the audit. Essays such as 240, 550, 570 are in principle relevant. This is because the element could be misstated as a result of fraud. Okay, all other standards are applicable. However, auditor, while conducting audit of single financial statement or a specific element of financial statement, he has to specifically consider requirement of these three standards. Why? Because the chance of occurring misstatement as per these three standards, the areas covered by these three standards is high. So auditor needs to specifically consider the requirement of these three standards. What are they? Fraud, effect of related party transactions, or the incorrect application of going concern base of accounting under the applicable framework. Okay, next, SA 260. What is SA 260? As per SA 260, you have to communicate with those charged with governance. Now, in the entity, there will be management, there will be those charged with governance, right? Those charged with governance is higher level of authority than the management, right? Management is generally concerned with you know, preparation of financial statements and overseeing of, not overseeing, management will be involved in the day-to-day activities, whereas those charged with governance will just oversee the entire financial reporting process and they will just oversee the entire activities. Okay, you can say those charged with governance are decision makers, they are having more power than the management. Now, in some entities, both management and those charged with governance can be same. Okay, in some entities management will be different and those charged with governance will be different. In some entities there will be common people between management and those charged with governance. Okay, like this also can happen. Let's say in a particular entity, Mr. A, B, C are part of management and Mr. B, D, F are those charged with governance. Now, if you see here, B is common in both management and those charged with governance. Okay, so it can vary based on the entity. Okay, it is decision of the entity to decide who will be management and who will be those charged with governance. Okay, so one, before starting the audit, auditor has to identify who is those charged with governance in this particular entity. Why he has to identify? Because he has to make certain communications to those charged with governance as per SA 260, right? Now, in the same way, what SA 2 how SA 260 is applicable for SA 805 in a different way is, let me explain. For audit of complete set of financial statements, B, D, F are those charged with governance. those charged with governance. Okay, that means any communications as per SA 260 has to be made with these people. Okay, now for audit of single financial statement or specific financial statements, it need not be that same people will be those charged with governance. Okay, some different people can be those charged with governance for audit of single financial statements, for preparation of single financial statements. Okay, so for preparation of single financial statements, only Mr. D might be those charged with governance. So before starting audit of single financial statements also, you have to identify who is those charged with governance. Okay, you cannot assume that those charged with governance for a complete set of financial statements will be those charged governance for single financial statements. You cannot take that assumption, because those charged with governance can be different for the single financial statements. So you need to specifically identify who is those charged with governance for audit of single financial statement or specific element of financial statement. Hope that is clear. So that is the applicability of SA 260. Earlier we used to read that all standards are applicable for audit of single financial statement or specific element of financial statements. Now we are reading how some specific standards will be applicable, like SA 260, how SA 260 is applicable. Okay, and why SA 240, 550 and 570 are specifically important. Okay, see, SA 260 requires the auditor to determine the appropriate persons within the entity's governance structure with whom to communicate. SA 260 notes that in some cases, all of those charged with governance are involved in managing the entity, and the application of communication requirements is modified to recognize this position. When complete set of financial statement is also prepared by the entity, those persons responsible for oversight of the preparation of single financial statements or element may not be same as those charged with governance responsible for oversight of preparation of complete set of financial statements. Okay, both can be different. So you have to specifically identify who is those charged with governance for audit of single financial statements or specific element of financial statement. Hope that is clear. So that is the amended portion in consideration when planning and perform the audit. Next, form of opinion. Now the form of opinion that has to be expressed will depend based on the requirements of applicable financial reporting framework, and which terminologies has to be used in your opinion. Okay, basically two types of terminologies can be used. One is presents fairly in all material respects, or gives a true and fair view. Okay, whether to use these two terminologies in the auditor's opinion or not, okay, that has to be decided by the auditor based on certain aspects. Let's see how. Auditor needs to see whether the applicable financial reporting framework is explicitly or implicitly restricted to the preparation of a complete set of financial statements. Okay, the financial reporting framework that has been used, whether it is restricted only for the preparation of a complete set of financial statements, or it can also be used for the preparation of single financial statements or the specific element of the financial statement. Based on this, auditor will decide whether to use the terms presents fairly in all material respects or gives true and fair view or not, and also whether the single financial statement or a specific element of a financial statement will comply fully with each of the requirements of the framework relevant to the particular financial statement or the particular element, and the presentation of the financial statement or specific element of financial statement include the related disclosure if necessary to achieve fair presentation, provide disclosures beyond those specifically required by the framework, or in exceptional circumstances depart from the requirement of the framework. Okay, auditor can use these terms in his opinion if the framework allows the auditor to deviate from the framework to in order to achieve fair presentation. Okay, we have already discussed in our classes there are two types of framework. One is compliance framework, another one is fair presentation framework. Okay, in case of compliance framework, auditor has to strictly comply with whatever is prescribed in the framework, whereas in case of fair presentation framework, auditor, if he wants, he can deviate, he can give more disclosures than required by the framework in order to achieve more fair presentation, right? So auditor needs to consider this in deciding whether to use these two terms in his opinion or not. Next, application of various other specific standards. Okay, for audit of a single financial statement and audit of a specific element of financial statements, how various other standards will be applicable with respect to the audit report. Let's see. First of all, SA 700 will apply for preparation of the audit report, the format of the audit report. See, auditor is required to apply requirements of SA 700 adopted as necessary in the circumstance of the engagement when forming an opinion and reporting on a single financial statement or a specific element of financial statement. Okay, the requirement of SA 700 he needs to apply. Okay, not only requirement of SA 700, requirement of all the standards will be applicable. But I have already told you na, institute by making an amendment has specifically inserted the requirements of certain specific standards. Okay, next requirement of SA 570, that is with respect to going concern. Okay, the responsibilities of management with respect to the going concern, responsibilities of auditor with respect to the going concern has to be inserted in the audit report. See, depending on applicable financial reporting framework used in preparation of single financial statement or the specific element of financial statement, the description in the auditor's report of management responsibilities relating to going concern may need to be adopted in the same way as necessary. In the same way, the description in the auditor's report of the auditor's responsibility may also need to be adopted as necessary depending on how SA 570 applies in the circumstance of the engagement. Okay, auditor needs to adopt the requirements of SA 570 with respect to management responsibilities and auditor's responsibilities for the purpose of this audit of a specific element of financial statement or single financial statement. Next, SA 701, the same. Okay, in SA 800 we have discussed now about SA 701. If auditor wants to give key audit matter, then SA 701 will be applicable. Okay, next SA 720 also same. If auditor wants to if management decides to give single financial statement or specific element of financial statement as part of a particular report, then that particular report will be considered as the annual report for the purpose of SA 720. And apart from that single financial statement, all the information that is present in that report will be considered as other information for the purpose of SA 720. And for such other information, the requirement of SA 720 is applicable. Okay, this we have discussed in our SA 800. The same will be applicable even here also. See, SA 720 deals with auditor's responsibility related to other information. What is other information? The information that is present in the report other than report means the report that the management issues. Okay, the document that the management issues. Okay, so all the information that is present in the document apart from the financial statements is known as other information. In the context of this essay, reports containing or accompanying single financial statement. Okay, generally management will not give just the financial statement. Okay, financial statement will be included in a particular document. Okay, so in the same way, single financial statement also, if management wants to issue it as part of a particular document, or a specific element of a financial statement, the purpose of which is to provide owners with information on matters presented in the single financial statement or specific element of financial statement, are considered to be annual reports. Okay, that entire document will be considered as annual report for the purpose of SS 720. When the auditor determines that the entity plans to issue such a report, the requirement of SS 720 apply to the audit of single financial statement or the element. Okay, this discussion we have already made in SA 800. Same discussion will be applicable here also. Next, auditor will sign the audit report. Signature of auditor. Auditor's report shall be signed. Okay, in case he is individual individual audit firm, then the sole proprietor he will sign along with his membership. If it is a firm, the engagement partner will sign on behalf of the firm along with his membership number and the firm registration number. Okay, see, the report is signed by the auditor in his personal name, where the firm is appointed as the auditor. The report is signed in the personal name of the auditor and in the name of the audit firm. The partner proprietor also need to mention membership number assigned by ICI. They also include registration number of the firm wherever applicable, as allotted by ICI in the auditor's report. Okay, this is with respect to signature. Next, implication of complete set of financial statement auditor's report for the audit of a single financial statement or specific element of financial statement. See, this is a complete set. On these complete set of financial statements, by auditing this complete set of financial statements, auditor will give audit report. Now, this is single financial statement. The single financial statements will also be derived from the complete set, right? Now, on single financial statement also, auditor will conduct and he will issue audit report. Okay, right? On single financial statement also, auditor will issue audit report. Now, whether the points that the auditor has mentioned in the audit report of complete set of financial statement will have any impact on the audit report on single financial statement, this needs to be assessed. Okay, if it will have any impact, auditor needs to mention this in the audit report of single financial statement or specific element of financial statement. Okay, or specific element. Now let's see how to decide whether it will have any impact or not. See, I hope you understood the context in which we are going to make this discussion. Considering whether a matter included in the auditor's report on complete set of financial statements is relevant to the context of engagement to report on a single financial statement or a specific element of financial statement involves professional judgment. Okay, deciding this involves a professional judgment, and auditor should also consider following points in deciding the implication. What are they? Factors that may be relevant in considering those implications include the nature of matter being described in the auditor's report on a complete set of financial statement and the extent to which it relates to what is included in the single financial statement or specific element of financial statements. Let's say, for example, in the audit report, of a complete set of financial statement, auditor has given some point or given some remarks with respect to a particular asset. Okay, now the single financial statement is profit and loss statement. Now, in this situation, the nature of item that has been referred to in audit report of a complete set of financial statement is different from the nature of a single financial statement. Okay, because in profit and loss statement there will not be any asset. So here the audit report of a complete set of financial statement will not have any impact on the audit report of single financial statement, because the single financial statement is profit and loss statement, whereas in the audit report of complete financial statement, remark is with respect to asset will be a part of balance sheet, right? So in order to decide whether there will be any implication, auditor needs to consider the nature, okay, nature of the matter being described in the auditor's report on the complete set of financial statement. Okay, next, auditor should also consider the pervasiveness of the matter described in the auditor's report on the complete set of financial statement. Okay, in the complete set of financial statement, auditor has described about an asset. Now the pervasiveness of such asset you need to consider. Let's say this asset regarding which the auditor has made a remark in the audit report forms 90% of total net worth of the company, or 90% of total assets of the company. That means here this is pervasive, and since there is a misstatement in this asset, it will also create a doubt on the going concern. Let's say for example, okay, let's say the company is banking company, and the asset for the bank, the major asset for the bank is loans that it has made. Okay, so of the loans that it has made, let's say 100 crore loans have been made. Of the 100 crores loan, 90 crores of loan is given to one party only. Okay, and that 90 crore loan, that party is not repaying, and the financial situation of that party is very bad. Okay, regarding this, the auditor has made a remark in the audit report. Okay, further the provision has to be given, but the company has not made a provision, so auditor has referred it in the auditor's report. Now if let's say that party becomes insolvent and he doesn't give that 90 crore to the company, to our banking company, then there is a chance that our company might not be able to run its business, because of the total 100 crore, 90 crore is gone. So there is a significant impact on the going concern. So here the matter is so pervasive that it is affecting the going concern, right? So in this situation, even though it is an asset and our single financial statement is a profit and loss statement, but the pervasiveness of this asset is very high. Okay, it is impacting various areas. Okay, because if going concern is gone, the entire business will be gone, right? The entire company has to be shut down. So in this situation, since it is pervasive, it is having pervasive effect, auditor, it will have impact on the auditor's report on single financial statement, even though such financial statement, that single financial statement is a profit and loss statement. Okay, so you should, along with the nature of the matter, you should also consider pervasiveness of the matter. Hope that is clear. Next, the nature and extent of differences between applicable financial reporting framework. Okay, you should also consider the nature and the differences between the financial reporting framework that is used for preparation of complete set and the financial reporting framework that is used for the preparation of the single financial statement. Okay, if the same financial reporting frameworks are used, then the differences will not be much. Okay, therefore the implication will be high. If the different financial statements, if the different financial reporting framework is used, then the audit report on complete financial statement will not have any impact on the audit report on single financial statement, because a different financial reporting framework is used for the preparation of single financial statement. Okay, next, you should also consider the extent of difference between periods covered by complete set of financial statement compared to the periods or dates of the single financial statement or the element of financial statement. Okay, you have to consider the period that is covered by the complete set of financial statement. Let's say for example, complete set of financial statement is for the entire year from 1st April 2023. Let's say it is complete set of financial statement is related to financial year 24-25, whereas single financial statement is related to financial year 25-26. In this situation, there will not be any impact of the audit report on complete financial statements on the audit report on single financial statement, because their periods are different. Okay, so you should also consider the periods that are covered by those respective financial statements. Next, the time elapsed since the date of auditor's report on a complete set of financial statements. Let's say for example, just a second, what happened? Yeah, let's say for example, this complete set of financial statements, they are related to financial year 2005 to 2006. Okay, so on this complete set of financial statements, auditor has given his audit report on auditor has given his audit report on some 16th August 2006. Now in 2005, okay, in 2005, sorry, in 2024, now in 2024, for some purpose, okay, for some requirement, company has prepared single financial statement of financial year 2005-2006. Okay, see, the period covered by complete set of financial statement and single financial statement is same 2005 to 6, but the audit report on complete set of financial statement is issued on 16th August 2006 at that time, but this audit report on single financial statement is being prepared on, let's say, 12th May 2004, sorry, 2024. Now if you see, the gap between these two audit reports is almost some 18 years. So if you see, the situations that are present during that time will be different from the situations that are present now. So there will not be any implication of this audit report on complete set of financial statement on the audit report on single financial statement. Okay, there will not be any implication because lot of time has lapsed, 18 years has lapsed. Okay, so you need to consider the time lapse between the two audit reports also. Here they have given an example. Let's see. For example, in the case when there is a qualification of auditor's opinion in relation to accounts receivable in the auditor's report on complete set of financial statement. Okay, in the audit report on complete set of financial statement, the qualification is with respect to accounts receivable, whereas the single financial statement includes accounts receivable or specific element of financial statement relates to accounts receivable, it is likely that there would be implication for that audit. Okay, if the single financial statement also includes the account receivable or the single element of the audit that the auditor is auditing is account receivable, then there is a high chance that there will be implication of the audit report on complete set of financial statement. Okay, the audit report on complete set of financial statement will have implication on the audit report on single financial statement or specific element, because the element is same. Okay, the audit report on complete set of financial statement qualifies with respect to accounts receivable, and here the auditor is also auditing the single element as accounts receivable or the single financial statement that the auditor is auditing includes accounts receivable. In this situation, the implication will be high. Okay. On the other hand, if the qualification of auditor's opinion on complete set of financial statement relate to classification of long-term debt, then it is less likely that there would be implication for an audit of single financial statement of profit and loss statement, because long-term debt is part of balance sheet and single financial statement is with respect to P&L, so there will not be any implication, or if the specific element of financial statement relates to accounts receivable. Okay, the similar example that I have given. Next, inclusion of reference to auditor's report on complete set of financial statement. If the auditor of single financial statement or the auditor of specific element of financial statement in his audit report wanted to give a reference to the audit report on complete set of financial statement, then such reference has to be given in which paragraph? In other matter paragraph, because this is related to the audit. Okay, whatever you wanted to communicate with respect to the audit, you have to communicate it in other matter paragraph as per SS 706. So such reference has to be given in in other matter paragraph as per SS 706. See, even when certain matters included in auditor's report on complete set of financial statements do not have implication for the audit of or for the auditor's report on single financial statement or specific element of financial statement, the auditor may deem it appropriate to refer to the matters in other matter paragraph in the auditor's report on single financial statement or on specific element of financial statement as per SS 706. Example, the auditor may consider it appropriate to refer it in the auditor's report on single financial statement or specific element of financial statement to material uncertainty related to going concern section included in the auditor's report on complete set of financial statement. Okay, the same example that I have given you just now. Okay, with respect to the going concern. So that is with respect to implication of a financial complete set of financial statement on the single financial statement or the element of financial statement. Next, forming opinion and reporting consideration. Now, forming opinion and reporting consideration is same, entire content is same, but some 2 points have been added. See, if the auditor's report on entities complete set of financial statements include modified opinion as per SS 705 or an emphasis of matter paragraph or other matter paragraph in accordance with SS 706. Okay, these 2 points were there earlier. Along with these 2 points, 2 more points has been given. See, now earlier before amendment, the situation was this is audit report on complete set of financial statement. Okay, now the auditor is giving audit report on single financial statement or specific element. Now, while giving the audit report on single financial statement or specific element of financial statement, auditor should also consider what is given in the audit report on complete set. Earlier, you need to consider only, you would be considering only two situations. What are those two situations? If the audit report on complete set of financial statement, if the audit report on a complete set of financial statement was having modified opinion as per SS 705 or was having emphasis of matter or other matter paragraph as per SS 706, as per 706. These two you used to consider. Now, as per the amendment, you should also consider if there is any paragraph related to material uncertainty related to going concern as per SA 570, or if there is any matter related to other information as per SA 720. Okay, if auditors report on complete set of financial statement has any of these 4 points, then auditor report on single financial statement should explain the effect of this matters here. Okay, you should refer this in the audit report on single financial statement or specific element of financial statement. Earlier only these 2 points were there. Now additionally these 2 points are also introduced. Hope this is clear. So if any of these 4 points are there in the audit report on a complete set of financial statements, then auditor shall determine the effect that this may have on the auditor's report on single financial statement or specific element of financial statement. Hope that is clear. So mostly by this the amendments of SA 805 got completed. Okay. Next moving to SA 810, audit report on summary financial statements. Now these summary financial statements, they will be derived from the complete set of financial statements, right? So there are not much changes here in this standard. So factors to be considered before accepting the engagement. One new point has been added in factors that has to be considered before accepting the engagement. The first point, what is that? The preparation of summary financial statements requires management to determine the information that needs to be reflected in the summary financial statements so that they represent a fair summary of audited financial statements. Okay, management has to determine which items or which points has to be included in the summary financial statements so that summary financial statements represent a fair summary of complete set of financial statements. Okay, because summary financial statements by their nature contain aggregated information and limited disclosure. Okay, summary financial statements by their nature means they are summarized format. They will not contain all the information. Okay, they will only contain summarized information that is taken from the complete set. There is an increased risk that they may not contain the information necessary so as not to be misleading in the circumstances. This risk increases when established criteria for the preparation of summary financial statements do not exist. Okay, so management has to determine which information has to be included in the summary financial statements. Hope that is clear. That is a new point that is added. And here if you see in the elements of the auditor's report on summary financial statement, the format of the audit report, there is no change in the format of audit report, but almost the same points are there. But here in the 7th point, let me first of all read the earlier requirement. If the date of auditor's report on summary financial statement is later than the date of auditor's report on audited financial statements, that means first first the complete set of financial statements have been audited and audit report is issued. After issuing the audit report on complete set of financial statements, now the auditor is issuing audit report on summary financial statements. Okay, after issuing audit report on complete set of financial statements. In such situations, state that the summary financial statements and the audited financial statements do not reflect the effects of events that occur subsequent to the date of auditor's report on the audited financial statements. See, earlier, let's say here on 31st June 2026, you have issued audit report on complete set of financial statement. Okay. Now, after issuing that on, let's say, 16th July 2026, you are issuing audit report on summary financial statement. Summary financial statement. Now, in this situation, the auditor's report on summary financial statements should include a point stating that this audit report and the audit report on a complete set of financial statements does not cover any events that occurred in this period. Okay, this needs to be mentioned in the audit report on summary financial statement. Now also this need to be mentioned, but not only in this specific situation, wherever the requirement occurs, you need to mention this. Okay, so they have striken off the earlier requirement of only covering the single situation, and they have mentioned if required. Okay, if required, based on the auditor's analysis, if required, in the audit report on summary financial statements, auditor can mention a point stating that the audit report on summary financial statements and audit report on a complete set of financial statements doesn't cover the events that have occurred after the date of auditor's report on a complete set of financial statements. Okay, so this point needs to be mentioned wherever it is required, not only in that specific situation that was there earlier. Okay, wherever it is required, auditor needs to mention this point. Hope that is clear. Next, modifications to the opinion. Now, just like in essay 805, 2 points were added, right? When audit report on complete set of financial statement contains modified report or key audit matter, emphasis of matter or other matter paragraph was there earlier. 2 more points. What are 2 more new added points? Material uncertainty related to going concern as per SA 570 and other information point as per SA 720. These 2 points are added as per SA 705. As per SA 805, in SA 805, these 2 new points were added. We have discussed. The same points are now added in SA 810 also. Along with those 2 points, 1 more point is also added. That is key audit matter is also added. Let's see. When auditors report on the audited financial statements, okay, here audited financial statements means complete set. When auditors report on a complete set of financial statements contains a qualified opinion or emphasis of matter or other matter paragraph, only these 2 points were there earlier. Now 3 more points are added. What are they? Material uncertainty related to going concern. Okay, this point we have already seen in SA 805, newly added point. And communication of key audit matter as per SA 701, and statement that describes uncorrected material misstatements of other information in accordance with SA 720. Okay, if auditors report on complete set of financial statement contains any of these 5 points, okay, either a qualified opinion or emphasis of matter or other matter paragraph or key audit matter paragraph or material misstatement in the other information as per SA 720 or material uncertainty with respect to the going concern as per SA 570, if any of these points are contained or contained in the audit report on complete set of financial statement, then in the audit report on summarized financial statements, auditor has to describe them. See, but the auditor is satisfied that summary financial statements are consistent in all material respect. The auditor's report on summary financial statement shall state that auditor's report on audited financial statement contain a qualified opinion or emphasis of matter or other matter or a material uncertainty related to going concern section, communication related to key audit matter, or statement that describes uncorrected material misstatement of other information. Okay, auditor needs to state this point that the summarized financial statements, I feel they are consistent, but in the audit report on complete set of financial statement, these are included. This needs to be you know said in the audit report on summarized financial statement, and also describe the basis of qualified opinion, describe the matter referred to in emphasis of matter or other matter paragraph or material uncertainty related to going concern section in the audit report on a complete set of financial statement, the uncorrected material misstatement of other information and the effect thereof on the summary financial statement. I hope you understood. Once I will just repeat this entire thing in the form of a diagram to make it even more clear to you. Now, this is audit report on complete set of financial statements. Okay. Now, in the audit report on complete set of financial statement, if there is modified opinion as per SS 705, or if there is emphasis of matter or other matter paragraph as per SA 706. These 2 points were there earlier. Now the additional 3 points are, if there is key audit matter paragraph as per SA 701, or if there is material uncertainty related to going concern as per SA 570, right? As per SA 570, or if there is a description of material misstatements in other information as per SA 720. Okay, if any of these points are present in complete set of in audit report on complete set of financial statements, then auditors report on summary financial statement should state that audit report on complete set of financial statement contains these points. Okay, make reference, and also you have to describe the impact on summary financial statements in your audit report on summary financial statement. Hope this is clear. I guess just there is one more amendment that is left from SA 810. Next amendment, other information in documents containing summary financial statements. See, now as I have already told you, summary financial statements, they can be issued as a part of some other document, right? So as a part of some other document, summary financial statements have been issued. Now, in this other document, all the information that is contained apart from summary financial statement will be known as other information, right? Now, if auditor finds any inconsistency in this other information, then okay, auditor finds inconsistency or misstatement, then earlier situation was auditor he himself would have to determine okay whether any revision required in other information. Okay, he has to determine whether any revision is required in other information, and if he thinks that revision is required in other information, then he will then he used to communicate with management. This was earlier situation, but now once he finds any inconsistency, he will immediately discuss with management, and in discussion with management he will determine any revision required, okay, any revision of other information required, and if management revises it, it is okay. If management refuses to revise, management refuses to revise other information, then he need to consider this, the implication of this on opinion. Okay, implication on opinion. Okay, this situation of management refusing to revise the other information is not there earlier, and also earlier auditor used to communicate with management after auditor used to communicate with management only if auditor feels that revision is required. Okay, now this is striked off, and this is the amended situation. Okay, if you want you can just make a note of this. You can pause the video and you can make a note. See, the auditor shall read other information included in document containing the summary financial statements. If the auditor identifies material inconsistency, then the auditor shall discuss the matter with management immediately and determine whether summary financial statements or other information included in document containing summary financial statement needs to be revised. Okay, statements and auditor's report thereon needs to be revised. This is the amended situation. Earlier situation I have struck off. Okay, what was the earlier situation? The auditor shall determine whether the summary financial statements or other information needs to be revised. Okay, this situation is not there. He needs to immediately communicate with management and then determine whether any revision is required in the other information or the financial statements. Now, this new situation is added, wherein if the auditor determines that information needs to be revised and management refuses to revise the information as necessary, auditor shall take appropriate action in circumstances including considering the implication for auditor report on the summary financial statements. Okay, this is the amended point with respect to the other information. Next, timing of work and events subsequent to the date of auditor's report. Basically, this is not an amendment. This was there earlier also, but this point I have not included in our audit concise book earlier. But now, why to leave this point? I have also included this point also in our audit concise fourth edition. Okay, so I have kept this here. Let's see. Timing of work and events subsequent to the date of auditor's report. Basically, this point we have discussed in SA 810 in various other situations. Let me tell you what is this point. Okay. In this class also we have discussed this point. The same example. I'll take to that same example. Yeah. Audit report on complete set of financial statement is issued on 31st June 2026. And audit report on summary financial statement is issued on 16 July 2026. Now, audit report on summary financial statement should include a point stating that this audit report on summary financial statements and also audit report on complete set of financial statements doesn't cover the events occurring in this period. Okay, the same is explained here in timing of report. See, report on audited financial statements. The auditor's report on summary financial statements may be dated later than the date of auditor's report on audited financial statements. In such cases, the auditor's report on summary financial statements shall state that the summary financial statements and the audited financial statements do not reflect the effect of events that occurred subsequent to the date of auditor's report on audited financial statement. Right? We have discussed this point with the example, the same example. Next, the auditor may become aware of facts that existed at the date of auditor's report on the date on the audited financial statements, but of which the auditors previously was unaware. In such case, the auditor shall not issue auditor's report on summary financial statements until the auditor's consideration of such factors in relation to audited financial statements in accordance with SA 560 has been completed. What is this? See, now there are some events and conditions, okay, that occurred before auditor's report on complete set of financial statement. Okay, here only they occurred, but as on the date of auditor's report, okay, while giving the auditor's report, auditor was not aware of those situations. Okay, so he has not considered them as on that date, but while giving audit report on summary financial statements on this date, he came to know about those situations, okay, that were present on date of auditor's report on complete set of financial statement, which he was not knowing earlier. Now, in this situation, he should not issue audit report on summary financial statements until and unless he resolves those situations as per requirement of SA 560. Hope that is clear. Next, when the auditor reports on summary financial statements after the completion of the audit of financial statements, the auditor is not required to obtain additional audit evidence on the audited financial statements or the report on effect of events that occur subsequent to the date of auditor's report on audited financial statements, since summary financial statements are derived from audited financial statement. Okay, if the same auditor is auditing the complete set of financial statements and also summary financial statements, then for the purpose of issuing report on summary financial statements, he need not obtain any further audit evidence, because he has already obtained the audit evidences while auditing the complete set of financial statements, right? So these are the amendments with respect to SA 800 series. Now moving to the amendments from the chapter audit of NBFCs. Now, if you see in this chapter, there are some major amendments that we need to see. Okay, the amendments from this chapter, they are important from the MCQ point of view. Okay, now if you see, the first amendment is with respect to net own fund requirement. You already know that in order to start the business of NBFC, you need to have certificate of registration with RBI and minimum net own funds of 2 crore rupees, right? This is the requirement. Now also the minimum net own fund requirement is 2 crore rupees, but in case of certain types of NBFCs, the different net own fund requirement is prescribed. Let us see. RBI has prescribed a timeline to meet net own fund amount of 10 crore in a phased manner for certain categories of existing NBFCs by 31st March 2027. What are those categories of NBFCs for which net own fund requirement of 10 crore is applicable? Okay, and a timeline has also been given for those NBFCs to reach the net own fund requirement of 10 crore rupees from the current net own fund requirement of 2 crore rupees. First of all, those three categories of NBFCs are NBFC ICC, that is Investment Credit Company, NBFC MFI, Microfinance Institution, and NBFC Factor. In case of these three NBFCs, net own fund requirement of 2 crore has been increased to 10 crore rupees, and this increase limit has to be achieved by 31st March 2027. If you see the timeline for achieving this requirement, in case of NBFC ICC, current net own fund requirement is 2 crore rupees. It has to be increased to 5 crore rupees by 31st March 2025, and the same has to be increased to 10 crore rupees by 31st March 2027. Okay, and in case of NBFC Microfinance Institute, the current net own fund requirement is 5 crores in general and 2 crores in case of northeastern region. Okay, NE region. In the northeastern region, states like Manipur, Meghalaya, Mizoram, Sikkim, Arunachal Pradesh. Okay, there are 8 northeastern states, right? So in those northeastern states, the net own fund requirements of NBFC Microfinance Institute is 2 crore rupees, and this has to be increased to 5 crore rupees by 31st March 2025 and 7 crore rupees by 31st March 2025 in general, and the same has to be increased to 10 crore rupees by 31st March 2027. And finally, in case of NBFC Factor, the current 5 crore has to be increased to 7 crore rupees by 31st March 2025, and the same has to be increased to 10 crore rupees by 31st March 2027. So this is the timeline within which these three NBFCs have to increase their net own fund requirement from the current 2 crore rupees to 10 crore rupees. Hope that is clear. And however, for NBFC, peer-to-peer NBFC, account aggregator, and NBFCs with no public fund and no customer interface, the net own fund shall continue to be 2 crore rupees only. For NBFC IFC, that is infrastructure finance companies and infrastructure debt finance companies, the net own fund requirement shall be 300 crores. Okay, this is the amendment. For NBFC IFC and NBFC IDFC, IDF NBFC, the net own fund requirement is 300 crore rupees. Hope that is clear. So this is the amendment in net own fund requirement. Next, coming to the prudential norms. If you see, in case of these prudential norms, there will be capital requirement, there will be provisioning requirement for NPS and income recognition. Now, if you see, in the capital requirement, earlier we used to discuss tier 1 capital, tier 2 capital for NBFCs. Now also the same tier 1 capital and tier 2 capital is there, but earlier for this tier 1 capital, for prescribing the tier 1 capital and tier 2 capital, the directions that were used by RBI was NBFC systematically important non-deposit taking company and deposit taking company, RBI directions 2016. Okay, in that as per those directions, the tier 1 capital and the tier 2 capital was recommended for the NBFCs that are prescribed in that direction. The tier 1 capital, tier 2 capital limits are prescribed, but now that direction has been changed as Reserve Bank of India non-banking financial company. Just a second, there is some network issue because of which the screen is disturbing. Just a second. So NBFC scale based regulation directions 2020-23. Okay, see, just the directions have been changed. Earlier, the NBFCs have been categorized based on deposit taking and non-deposit taking. Now, if you see in the previous year, a amendment has been given wherein scale based regulation was introduced, right? NBFCs were categorized based on their scale, okay, base layer, middle layer, top layer, upper layer. So for those NBFCs, okay, Reserve Bank of NBFCs that are present in Reserve Bank of India non-banking financial company, scale based regulation direction 2023 shall maintain minimum tier 1 capital and tier 2 capital of 15%. Those percentages, everything is same, just the directions, the name of the directions has changed. Okay, see, minimum tier 1 and tier 2 capital not less than 15%. Earlier also it was 15% only. And tier 1 capital of applicable NBFCs other than NBFC MFI and NBFC primarily engaged in lending against gold jewelry. Okay, apart from these two NBFCs, remaining all other NBFCs have to maintain tier 1 capital of not less than 10%. Okay, earlier it was infrastructure debt finance NBFC, now it is removed and in its place NBFC primarily engaged in lending against gold jewelry is introduced. And NBFC is primarily engaged in lending against gold, they should maintain minimum tier 1 capital of 12%. This one we already know, right? There is no change in that point. 12%, now also they should maintain 12% only. Okay, next. Now, what will be included in tier 1 capital, what will be included in tier 2 capital? Okay, this is not discussed in our study material earlier, but now the institute has given the calculation of tier 1 capital and tier 2 capital. Okay, what will be included in tier 1 capital and what will be included in tier 2 capital? This calculation is very much important. Let's see, because there is some complexity involved in this calculation, you please observe. Tier 1 capital for NBFC except NBFCs that are present in base layer. Okay, what are the NBFCs that are present in base layer? Non-deposit taking NBFCs whose assets are less than 1000 crore rupees, NBFC account aggregators, NBFC peer-to-peer, and NBFC, yeah, these are the, still there is one more NBFC, I don't remember the name. So these are the NBFCs that are included in NBFC base layer, right? So tier 1 capital for NBFCs except the NBFCs that are present in base layer is some of the following. What should be included in tier 1 capital? Let's see. Owned funds as reduced by investment in shares of other NBFCs and in shares, debentures, bonds outstanding. Just a second. Let me start this again. So, calculation of tier 1 capital. tier 1 capital for NBFCs except NBFC base layer is the sum of owned funds as reduced by investment in shares of other NBFCs and in shares, debentures, bonds, outstanding loans and advances, including the hire purchase and lease finance made to and deposits with subsidiaries and companies in the same group exceeding in aggregate 10% of the owned fund. What is this? See, calculation of net owned fund. Sorry, calculation of tier 1 capital. Let's say owned funds of NBFC is 200 crore. Okay, these are the own funds of NBFC. And investments made in the shares of other NBFCs. Okay, investment in shares of other NBFC. Let's say it is 5 crore. Okay, next, investment in other shares, debentures, all these points are there na. Investments in shares, debentures, bonds, outstanding loans, advances. Okay, advances, outstanding loans, all these are, let's say, 20 crores. Let's say not 20 crores, 25 crores, or let's say 30 crores. Okay, now let's see next. Perpetual debt instruments issued by non-deposit taking NBFC in each year to the extent it does not exceed 15% of the aggregate tier 1 capital of such company as on 31st March of the previous accounting year. I'll explain you this later. First of all, we'll calculate point A. Now if you see in point A, it says own funds has to be reduced by investment made in the shares of other NBFC, right? So here our own funds are 200 crore minus investments in shares of other NBFC 5 crore. Okay, next what it says, and you need to observe here it is and in shares, debentures, bonds, outstanding loans, advances, including hire purchase and lease finance made to and deposits with subsidiaries and companies in the same group exceeding in aggregate. That means all these items from here to here in aggregate exceeding in aggregate 10% of the owned fund. That means all these items which are more than 10% of the net owned funds has to be reduced from the net owned funds. Let me tell you. Here our net owned fund is 200 crore. 10% of net owned fund is 200 crore into 10%, that is equal to 20 crore. So this is 10% of net owned fund. Now investments in shares, debentures, outstanding loans, advances, all these taken together which exceeds 10% of the net owned fund. That means here second point, all these in aggregate is 30 crore, right? So 30 crore exceeding 10% of net owned fund means 30 crore minus 20 crore, because 10% of net owned fund is 20 crore, that will become 10 crore. So this amount has to be reduced from the net owned fund. Okay, now tier 1 capital becomes 200 crore minus 5 crore minus 10 crore, it becomes 185 crores. This is how you need to calculate. Still, this is not the entire tier 1 capital. Okay, this is part A of tier 1 capital. Still, for this, you need to reduce the perpetual debentures. Let us also reduce that perpetual debenture point. Okay, so from 185 crore, you should also reduce perpetual debenture. Let's see that. Point number B, right? Actually, my screen, it's not working. Just a second. Yeah, let me erase this point B. Yeah. So you need to perpetual debt instruments issued by non-deposit taking NBFCs in each year. You need to underline this, each year, to the extent it does not exceed 15% of the aggregate tier 1 capital of such company as on 31st March of the previous accounting year. Okay, it should not exceed 15% of the aggregate tier 1 capital of the previous accounting year. See, first of all, what is meant by perpetual debt instrument? See, let's say you have issued debentures and these debentures are irredeemable, then they will become perpetual debt instruments because they are not redeemable. They will continue lifelong. So these are perpetual uh, debt instruments, right? Now, for calculating tier 1 capital, you should also add this perpetual debt instruments that are issued during the current year. Okay, not the perpetual debt instruments that are carried forward from previous years. Okay, only the newly issued perpetual debt instruments has to be included. Let's say perpetual debt instruments issued during the current year for which you are calculating tier 1 capital, or let's say some 100 crore. Okay, and let's say you are calculating tier 1 capital for financial year, or you are calculating tier 1 capital in the, yeah, in the financial year 2023, in the financial year 2023-24, right? For this financial year 2023-24, you are calculating tier 1 capital, and the perpetual debt instruments issued during 2023-24 are 100 crores. Now, the tier 1 capital of previous year, okay, tier 1 capital of financial year 2022-23 is, let's say, some 200 crore. Okay, this is the tier 1 capital of the previous financial year. Now 15% of the tier 1 capital of previous financial year. See, 15% of 200 crore will be how much? 30 crores, right? Yeah. So maximum 30 crores of these perpetual debt instrument you have issued during the year, you can add to the tier 1 capital of the current year. So as per point A calculation, you have arrived tier 1 as 185 crores. For this 185 crores, okay, now the total tier 1 capital is equal to 185 crore plus 30 crore. The 30 crore is the perpetual debt instrument that you have issued during the current year. During the current year, you have issued 100 crores, but the maximum amount of perpetual debt that you can add to your tier 1 capital of current year is restricted to the 15% of tier 1 capital of previous financial year. That is the reason why you have calculated 15% of 200 crores, which will be 30 crores. You are adding only 30 crore to the tier 1 capital of current period. Okay, so now the tier 1 capital of current period, it will be 215 crores. Okay, this is the tier 1 capital of the current financial year. This is how you need to calculate tier 1 capital. Hope you are clear with this calculation. If you want, you can just make a note of this calculation. Okay, you can pause your video and you can make a note. Hope you are done. Now we'll move to calculation of tier 2 capital. And if you see here note, NBFCs that are in base layer are not eligible to include perpetual debt instruments in their tier 1 capital. Okay, NBFCs in the base layer, they cannot include this perpetual debt instrument in the tier 1 capital. Okay, for NBFCs which are in base layer, you need to calculate tier 1 capital only as per point A. Hope that is clear. That is the reason why in the first point it says tier 1 capital for NBFCs except NBFCs that are present in the base layer, because for NBFCs that are present in the base layer, you need not consider this perpetual debt instrument. Okay, only with the help of point A you need to calculate tier 1 capital for NBFCs that are in base layer, and for all other NBFCs you need to consider these two, point A and point B, for calculating the tier 1 capital. Okay, next, moving to calculation of tier 2 capital. Again, tier 2 capital also, while calculating tier 2 capital also, the NBFCs which are in base layer, they cannot include perpetual debt instruments. Basically, we have seen of the total 200 crores. Okay, I'll explain you that. First of all, we will see this. Tier 2 capital for NBFCs except NBFC which are in base layer is a sum of preference shares other than those which are compulsorily convertible into equity. Okay, first of all, you have to add the preference shares which are not convertible into equity shares. Okay, only those preference shares which are not convertible into equity shares has to be added to tier 1 capital. Okay, if any preference shares are compulsorily converted into equity shares, then you need not include them into tier 2 capital. Okay, next, revaluation reserves at a discounted rate of 55%. Okay, if there is a revaluation reserve in the books of accounts of rupees 100 crore, then 55% of 100 crore, that means 55 crores you can include in calculation of tier 2 capital. Okay, next, general provisions including that for standard asset and loss reserve to the extent these are not attributable to actual diminution in value or identifiable potential loss in any specific asset or available to meet unexpected losses to the extent of 1 and 1/4% of risk weighted asset. Okay, the general provision, the 1%, and loss reserves 1/4% of risk weighted asset you can add. Next, hybrid debt capital instruments. Okay, those instruments which are both in the nature of equity as well as debt. Okay, those type of instruments also you have to add into tier 2 capital. Let's say you have issued debentures. Okay, half debentures are convertible into equity shares and half debentures are redeemable. This is hybrid debt instrument. Okay, next, subordinated debt. What is meant by subordinated debt? Subordinated debt means such a type of debt whose settlement will be done after settling all the debts. Okay, subordinated debt will be settled at last. Okay, that will be known as subordinated debt. Next, perpetual debt instruments issued by non-deposit taking NBFC, which is in excess of what qualifies for tier 1 capital. Now if you see, for calculation of tier 1 capital, we have taken 15% of previous year's tier 1 capital as inclusion for the purpose of perpetual debt instruments, right? The remaining portion which is not included into tier 1 capital can be included into tier 2 capital. If you see here, of the 100 crores, we have included 30 crores in the tier 1 capital. Remaining 70 crores is there, na, that you can include in tier 2 capital. Hope that is clear. So this is how you will calculate tier 1 capital and tier 2 capital. Okay, now these tier 1 capital and tier 2 capital is there, na, it should be at least 15% of risk weighted assets. Hope that is clear. Now for calculating the percentage, you need the risk weights for each asset, right? Previously we are having risk weights for each asset. Okay, based on the asset the percentage weight is given. Now in this list a new item has been added, which is this one. See, for consumer credit exposure categorized as retail loans excluding housing loans, educational loans, vehicle loans, loans against gold jewelry and microfinance, SHG loans. Okay, for consumer credit exposure other than these loans, the risk weight is 125%. Okay, and for credit card receivables also the risk weight is 125%. Okay, yes. Now we will see the amendment with respect to asset classification. The assets, the loans that the NBFC will give will be classified into standard asset, substandard asset, doubtful asset, loss asset. Okay. Now there is no change in these 4 categories, but the way in which the NBFCs are categorized has been changed, right? Previously NBFC categorization was deposit taking, non-deposit taking, but based on a amendment that has come 1 year back, NBFCs are categorized on a scale based regulation basis, like the base layer, middle layer, top layer, upper layer. So the asset classification criteria has been fixed from the point of view of that scale based categorization of NBFCs. Previously the asset classification of NBFC, the NPA calculation, it has been prescribed based on NBFC non-systematically important non-deposit taking company Reserve Bank Direction 2016, right? Based on that, if the NBFC is a deposit taking NBFC, then the substandard asset categorization will be 18 months or more. If it is a non-deposit taking, then it is 12 months. Like this it was there based on deposit taking or non-deposit taking, but now it is shifted. Okay, the way in which the classification is done is shifted to scale based regulation. Okay, see, first of all, asset classification, standard asset. The standard asset is similar. Okay, those assets in case of which there is no default is known as standard asset. Substandard asset. Now, an asset which has been classified as NPA for a period not exceeding 18 months except for NBFC, ML and above. That means for NBFCs which are in the base layer, for those NBFCs, the assets of those NBFCs which have been classified as NPA for a period not exceeding 18 months will be treated as substandard assets. Okay, and for assets of NBFCs which are in middle layer and above, it is 12 months. Okay, further, an asset which has been classified as NPA for period not exceeding 12 months for NBFC middle layer and above will be considered as substandard asset. Okay, earlier this classification or categorization was done based on whether NBFC is non-deposit taking and deposit taking. Okay, based on this categorization it was done, but now it is shifted to whether it is in the base layer, middle layer, or upper layer, top layer. Hope that is clear. See, now substandard asset. An asset will be treated as a substandard asset in case of NBFCs that are in base layer. Okay, in case of those NBFCs, if the asset is classified as NPA for period not exceeding 18 months. Okay, whereas in case of NBFCs which are in middle layer, top layer, upper layer, it is for period not exceeding 12 months. Okay, earlier it was for non-deposit taking NBFC, for deposit taking NBFC. Okay, like this it was there. Now it has been shifted from the point of view of base layer, middle layer, top layer, upper layer. Okay, the months is same, but the way in which it is categorized is shifted. Hope that is clear. Next, the same type of change in case of doubtful assets also. Let me read this point B also. An asset where the terms of agreement regarding interest and principal have been renegotiated or rescheduled or restructured after commencement of operations until the expiry of 1 year of satisfactory performance under the renegotiated or rescheduled or restructured terms, provided that the classification of infrastructure loan as a substandard asset shall be in accordance with the provisions of paragraph 17 of these master directions. Just a second, let me read it again. An asset where the terms of agreement regarding interest and or principal have been renegotiated. Okay, the rate of interest or the repayment of principal, these terms have been renegotiated or rescheduled or restructured after commencement of operations until the expiry of 1 year of satisfactory performance under the renegotiated or rescheduled or restructured terms, that asset will be classified as a substandard asset only. See, if any renegotiation in the terms of the loan with respect to interest or principal repayment has been done, then till a period of 1 year from the date of such renegotiation, this asset will be classified as substandard asset only. Hope that is clear. Because since renegotiation has been done, you will check whether they are properly repaying as per the renegotiated terms or not. Okay. Next, provided that the classification of infrastructure loan as a substandard asset shall be in accordance with the provision of paragraph 17 of these master directions, Reserve Bank of India, non-banking financial company scale based direction 2017. Okay, for classifying infrastructure loan as a substandard asset, a different criteria is prescribed in paragraph 17. Okay, you need to follow that. Next, doubtful asset. Again, in doubtful asset also shall mean a term loan, lease asset, hire purchase or any other asset which remains a substandard asset for a period exceeding 18 months. Okay, if an asset remains as substandard asset for a period exceeding 18 months in case of NBFCs which are in base layer, okay, then such assets will be treated as doubtful asset. Okay, here you can see except for NBFCs which are in middle layer and above. Okay, except for these NBFCs means the remaining NBFCs are NBFCs which are in base layer only. For NBFCs which are in middle layer and above, for them it is period exceeding 12 months. Okay, the same, the period has not changed. Okay, the way in which the classification is done has been changed. Okay, next, loss asset, there is no change in the loss asset. Next, non-performing asset. Now, earlier for the definition of non-performing asset, it was 6 months or more. Okay, there are various situations like an asset in respect of which interest has remained overdue for a period of 6 months or more. Term loan including unpaid interest where installment or interest is overdue for a period of 6 months or more. Demand loan or call loan which remained overdue for a period of 6 months or more. Like this, there are various types of situations in which it is outstanding for a period of 6 months or more. Then you will call it as NPA. Right, now all this has been changed to 180 days. Okay, more than 180 days. It has been harmonized to more than 180 days. See, more than 180 days, more than 180 days, more than 180 days, more than 180 days, more than 180 days. Okay, all this definition of NPA has been harmonized by including more than 180 days. See, earlier, lease, rental and hire purchase installment which has become overdue for a period of 12 months and more will be treated as NPA, but now it has also been changed to more than 180 days to harmonize the definition of NPA. Okay, that is a change. Okay, here they have changed the period from 6 months or more to more than 180 days in case of definition of NPA, a simple change. Next, note, the period of more than 180 days for NPA classification as mentioned above shall be adjusted as per the glide path outlined as under. Now, this change of 180 days is as of now. Okay, it has to be reduced to 90 days over a period of time for certain categories of NBFCs. Let us see that. What is the timeline? Okay, non-performing asset glide path. The extant NPA classification norm stand changed to the overdue period of more than 90 days for applicable NBFCs. Here for applicable NBFCs means those NBFCs which are in base layer. Okay, for these NBFCs, a glide path is provided to applicable NBFCs to other to 90-day norm as under. Okay, as of now, for NBFCs which are in middle layer, top layer and upper layer, for these NBFCs, the definition of NPA is 90 days or more only. Okay, only for the NBFCs which are in base layer, it is 180 days. Now, this 180 days should also be reduced to 90 days over a period of time. See, NPA norms, it should be 150 days overdue by 31st March 2024. Okay, and it should be further reduced to 120 days overdue by 31st March 2025, and finally it should be reduced to 90 days overdue by 31st March 2026. See, here we are discussing about definition of NPA. Okay, in the definition of NPA, it is there now more than 180 days. If interest is outstanding more than 180 days, if the repayment is not made more than 180 days, the definition is there now that more than 180 days has to be reduced to more than 90 days over a period of time. Okay, some 3 years time gap has been given to NBFCs which are in base layer to follow this. Okay, so in this manner they have to reduce that 180 days to 90 days. Okay, from 2026 31st March 2026 onwards, the definition of NPA for all NBFCs will be 90 days or more. Okay, the the glide path will not be applicable to NBFCs which are already required to follow 90-day NPA norm. Okay, as of now, NBFCs which are in middle layer, top layer, and upper layer, they are following this 90-day NPA norm. Okay, in case of these NBFCs, if the loan is outstanding for more than 90 days or interest is not received for more than 90 days, it is being classified as NPA. Okay, so since they are already following this 90-day NPA norm, they need not follow this glide path. Okay, only since NBFCs which are on base layer are not following 90-day NPA norm, they have to reduce that 180 days to 90 days over this period of time. Hope that is clear. Next, provisioning requirement. In case of provisioning requirement also, there is not much change. Okay, the percentages are similar except for standard asset. Okay, in case of standard asset, for NBFCs which are non-deposit taking and deposit taking, it was 0.4% now earlier. Okay, earlier you used to calculate the provision in case of a standard asset based on these directions, right? NBFC, non-deposit taking, systematically important, and deposit taking company reserve bank direction, those directions have been taken off now, and the new directions which are scale based regulation direction are given. See, NBFC base layer shall make provision for standard asset at 0.25% of the outstanding which shall not be reckoned for arriving at net NPAs. Okay, in case of NBFCs which are in base layer, they have to maintain the provision of 0.25% for the standard asset. See, here for NPA calculation, for these provisioning calculation, a shift has been made from deposit taking, non-deposit taking NBFC type of calculation to scale based NBFC's categorization. Okay, just a shift has been made from those type of NBFC to this type of NBFC. Okay, okay, the provision towards the standard asset need not be netted off from gross advances but shall be shown separately as contingent provision against standard asset in the balance sheet. Okay, the provision that you have made for these standard asset which is 0.5%, it need not be netted off, it can be shown separately as contingent provision against standard asset in the balance sheet. Next, standard asset provisioning not applicable for NBFC upper layer. That means for NBFCs which are in middle layer and top layer. Okay, for NBFCs which are in middle layer and top layer, they have to make 0.4% as provision for standard asset. And for which are in upper layer, some different percentages are prescribed. Those percentages, they are not there in our syllabus. Okay, so in case of standard asset, for NBFCs which are in base layer, the provision is 0.25%, and for NBFCs which are in middle layer and top layer, the provision in case of standard asset is 0.4%. Okay, next, a small change Every NBFC shall submit certificate from its statutory auditor that is engaged in the business of NBFC financial institution requiring it to hold a certificate of registration under section 45A of the RBI Act and is eligible to hold it. A certificate from the statutory auditor in this regard as at the end of financial year ended 31st March may be submitted to regional office of the Department of Non-Banking Supervision. Right. So every NBFC at the end of the financial year it has to submit a certificate from the auditor stating that the company, the NBFC is holding the certificate of registration from RBI and it is eligible to hold this registration. Like this, a certificate has to be submitted. Like this, a certificate has to be taken from auditor and it should be submitted to Department of Non-Banking Supervision. And the time limit has been changed. Okay, this certificate has to be submitted within 1 month from the date of finalization of balance sheet previously. Now this timeline has been changed to within 5 working days from the date of signing of audit report, but not later than 31st December of the same year. Okay, you have to submit this certificate from the auditor to regional office within 5 working days from the date on which auditor has signed his audit report, but not later than 31st December of the year. Okay, so the time limit has been changed. Earlier it is within 1 month from the date of finalization of balance sheet or 30th December you need to submit it, but it is changed now to within 5 days from the date on which auditor has signed audit report or but not later than 31st December of the same year. Okay, so there is a change in the time limit within which you need to submit the certificate from the auditor. Next, here in case of uh, this NBFCs, the directions has been changed. Okay, you need to see in case of NBFC accepting or holding public deposits, auditor needs to report whether capital adequacy ratio as disclosed in return submitted to bank as per the systematically important non-deposit taking company and deposit taking company Reserve Bank direction. It was there earlier. Now this direction has been stricken off and it is changed to in terms of master direction Reserve Bank of India non-banking financial company scale based regulation direction 2023. Okay, this change has been done in various places. If you see here also, this direction has been removed and the new direction has been inserted. Here also this direction has been removed. Whether the company has furnished RBI within stipulated period return on deposits under NBFC returns Reserve Bank direction. Okay, now this direction is not there and in its place new direction has come, which is master direction Reserve Bank of India filing of supervisory return direction 2024. Okay, and the form in which you need to file is DNBS 1. Again here also quarterly return on prudential norms, the directions has been changed. Okay, this direction old direction has been striken off and a new direction which is master direction Reserve Bank of India filing of supervisory returns direction 2024. Okay, that is a small change where old direction has been striken off and a new direction is introduced. Here also again new direction master direction Reserve Bank of India non-banking financial company scale based regulation direction. Here also change of the direction. Okay, this old direction taken off, new direction introduced. Okay, so these are the changes in case of NBFC. Still we have amendments from audit of banks and professional ethics, right? We have these two. Okay, we'll do one thing. The amendments of these two chapters, I guess these are not major amendments. Okay, let us discuss them in this video only. Why to again make another video for these remaining amendments? Let's cover this here only. So amendments from audit of banks. Now if you see, for calculation of CRR, cash reserve ratio, and statutory liquidity ratio. First of all, what is a cash reserve ratio? There is no change in the definition of cash reserve ratio. Okay, it is a specified minimum fraction of total deposits of the customer which commercial banks have to hold as a reserves in cash or deposits with the central bank. This is in order to meet the sudden cash withdrawals from the customers. Okay, these CRR and SLR will be maintained in order to meet sudden withdrawals from the customers. Now, this CRR and SLR are there now. For calculating this CRR and SLR, you need to understand the term demand and time liabilities. Okay, on these demand and time liabilities, the percentage of CRR and SLR, they will be calculated, right? So the amendment that has come is in the points of exclusion from demand and time liabilities. Okay, while calculating demand and time liabilities, you have to exclude certain items and you have to specifically include certain items. So certain new points have been introduced in exclusions from demand and time liabilities, and also in inclusions in demand and time liabilities. So we'll see what are the points, additional points that are included in exclusions from demand and time liabilities. You need to exclude bills discounted by bank with eligible financial institutions as approved by RBI. Now, bank, our bank, it would have taken bills from the customer. Okay, and it would have given amount to the customer for that respective bill after deducting its commission. Now, bank, it can again discount this bill with other bank. Okay, so if the bank discounts this bill with the other bank, then till the time that bill is discharged by the original customer, it will be liability of the bank, right? Because if the original customer doesn't discharge that bill, the bank has to repay the amount. Now this should not be included in the demand and time liabilities. Okay, bills discounted by bank with eligible financial institution should not be included for calculation of demand and time liabilities. Next, net income tax provision should also not be included in demand and time liabilities. Amount received from DICGC towards claims held by banks pending adjustments thereof. Now DICGC means Deposit Insurance Guarantee Credit Guarantee Corporation. Okay, Deposit Insurance Credit Guarantee Corporation. Now basically with every bank, people will deposit the amount, right, in the form of either savings accounts or deposit accounts. So for each every account, for each and every deposit holder, there is a automatic insurance cover of up to 5 lakh rupees that will be provided by DICGC. Okay, for each and every deposit account that a customer will have with the bank, there is a automatic insurance of up to 5 lakh rupees. That means if the bank fails to repay the amount to the deposit holder, DICGC will repay the amount that the customer is holding with the bank. This insurance facility is up to 5 lakh rupees. Now, if such insurance amount is received, then it should not be included in demand and time liabilities. Okay, let's say bank has failed to repay its deposit holders. So the insurance has triggered and DICGC has given, let's say, insurance amount of 1 crore rupees. Now this insurance amount of 1 crore rupees will be given to the bank has to repay it to the customers, right? Now this amount of insurance which the bank has received, it should not be treated as it should not be included in demand and time liabilities. Hope that is clear. Next, amount received from Export Credit Guarantee Corporation by invoking the guarantee. ECGC means Export Credit Guarantee Corporation. Basically what this ECGC will do is it will provide insurance to the Indian exporters. Okay, now Indian exporters, they will export to outside India. When they export, they will receive amount from buyers. If in case those buyers don't give the amount to the exporters, ECGC will give the amount to the exporters by invoking the insurance. So amount received from ECGC by invoking the guarantee by the bank should not be treated or should not be included for calculation of demand and time liabilities. Next, amount received from insurance companies for ad hoc settlement of claims pending judgment of court. Okay, if any amount received from insurance company as an ad hoc settlement, those amounts should also not be included in demand and time liabilities. Next, amount received from court receiver. Court receiver means, let's say bank is there now. Our bank has given loan to A Limited. Now A Limited is in the stage of insolvency. It is not able to repay the amount. So it went to winding up. Now during winding up or during insolvency, receiver will be appointed for A Limited. What receiver will do? Receiver will sell the assets of the company. He will collect the amount and he will repay the amounts to the lenders. So in such way, if amount is received from court receiver to the bank, that also should not be treated as, that also should not be included for calculating demand and time liabilities. Okay. Next, net unrealized gain or loss arising from derivative transactions under trading portfolio. Okay, you will be learning about derivative transactions in your AFM. So loss or profit from these derivative transactions should also not be included in demand and time liabilities, because these derivatives, they will be settled at the end of the period. Okay, till the derivatives expire, there will be either liability position or asset position, right? So that position should not be included for the calculation of demand and time liabilities, because it is going to expire at the end of the period. Next, income flows received in advance, such as annual fee and other charges which are not refundable. Okay, if you have received any advance receipts in the form of annual maintenance charges or any locker rent charges, basically the locker rent charges and other charges, in some cases you can receive for the entire period at the beginning of the period only. Now in this situation, these locker rent which you have received at the beginning of the period for entire period, it is not refundable, but you have received advance. Since it is not refundable, you should not show it as demand and time liability for calculation. Okay. Next, liabilities arising on account of utilization of limit under bankers acceptance facility. What is this bankers acceptance facility? Basically, let's say there is A Limited. Okay, A Limited. Okay, A Limited is customer of bank. Okay, now bank can give BAF facility to this A Limited. Basically, BAF facility is a type of credit facility that will be given by bank, and this BAF facility, there will not be any security offered. Okay, A Limited will not offer any security for this facility. Okay, and this BAF facility, it will not be given for all the customers, only for high trustworthy customers this BAF facility will be given. Now under this BAF facility, what will happen? Let's say A Limited purchased goods from B Limited. Okay, A Limited purchased goods from B Limited. Now for this purchase, A Limited has to pay amount to B Limited, right? So what A Limited will do is, A Limited will just issue a check to B Limited, but A Limited is not having any funds in the bank, but A Limited is having this BIF facility with the bank. So since A Limited is having BIF facility, let's say BIF facility is till 20 lakh rupees. That means, and A Limited has issued check for 10 lakh rupees. Now B Limited can deposit this check of 10 lakh rupees and the bank will honor this check because A Limited is having BIF facility with the bank, okay, till 20 lakh rupees. This is how this BIF facility will work. Now the liabilities that have arisen under this BIF facility should not be treated should not be included for calculation of demand and time liabilities. Okay. So those are exclusions. Coming to the inclusions in demand and time liabilities. Interest accrued on deposits should be calculated on each reporting fortnight, whether or not such interest is accounted for in books of accounts, so that bank's liability in this regard is fairly reflected in the total net demand and time liabilities of the same fortnightly return. Now, bank, it will pay interest to the deposit holders on savings deposits, on fixed deposits. Bank will pay interest. This interest it will generally pay on a monthly basis. But for purpose of calculation of this demand and time liabilities, for every 15 days, you will calculate demand and liabilities. Demand and time liabilities, right? So for every 15 days you need to calculate accrued interest on these deposits for the purpose of proper inclusion of these interest in the calculation of demand and time liabilities. Okay, next, cash collaterals received under collateralized derivative transaction, as these are in the nature of outside liabilities. Okay, if you have received any cash collateral for collateralized derivative transaction, then you need to include that cash collateral for the purpose of calculating demand and time liabilities. What is this? Let me tell you. Let's say bank has entered into interest rate swap agreement. Okay, you have learned about this interest rate swap agreement in your AF. So bank and a company, let's say A Limited. Now they have entered into interest rate swap. So under this interest rate swap, what will happen? Let's say as of now, A Limited is paying floating interest rate on a particular loan. Okay, floating interest rate. Floating interest rate, it keeps on changing based on the changes made by the RBI, and based on the inflation rate, this floating interest rate, it will keep on changing. But A Limited doesn't want to take this risk. It wanted to pay fixed interest rate. So for this purpose, A Limited will enter into interest rate swap agreement with bank, wherein bank will pay fixed interest. Wherein, let's say, presently for a particular loan, A Limited is paying floating interest rate. It wanted to pay fixed interest rate. So it has entered into interest rate swap agreement with bank. So now bank will collect fixed interest from A Limited. Let's say as of now, as on the date of entering into the agreement, A Limited is paying floating interest rate at the rate 8.5%. And this floating interest rate, it can either increase or decrease in the future. A Limited doesn't know. In order to avoid this risk, A Limited wanted to go for a fixed interest rate. Okay, so it wanted to fix its interest rate. So it has fixed its interest rate at 9%. And paying, A Limited is paying the bank 9% fixed interest. And in return for this, bank will pay the floating interest for that loan. Okay, so here you can ask, A Limited is paying 9% and bank is paying only 8.5%. As of now, bank is paying 8.5%. But next month, if the interest rate of that loan increases to 10%, then bank has to pay 10%, but A Limited will pay 9% only. Okay, it will not pay any excess interest because it has entered into a interest rate swap agreement with bank. Now, in order to cover the risk, bank will collect certain cash collateral from A Limited. Okay, cash collateral. Okay, because in future, let's say for example, the floating interest rate has reduced to 4%. If that means bank will pay interest rate of 4%, but bank will collect interest rate of 9% from the A Limited. Now, in that situation, to avoid risk of A Limited not paying fixed interest to bank, it will collect some security amount from A Limited. Let's say cash collateral of some 1 lakh has been collected. Now, this cash collateral of 1 lakh is a liability for the bank. Okay, it has to be repaid to the A Limited after this agreement ends, right? So, for calculation of demand and time liabilities, you have to include this cash collateral amount. Hope that is clear. So, those 2 points are added for inclusions in detail. Next. And some additional verification points are added. Let us see them. While examining computation of DTL, the auditor may specifically examine details of exempted categories of following items. What are they? Minimum eligible credit and outstanding long-term bonds to finance infrastructure loans and affordable housing loans as per RBI circular. Okay, you need to properly calculate whether these have been excluded from DTL or not. Next, these are exempted. See, while examining computation of DTL, auditor may specifically examine details of exempted categories. Okay, all these items are exempted from inclusion in DTL calculation. Next, the eligible amount of incremental FCNR. FCNR means foreign currency non-resident account. Now, in this FCNR account, the non-resident Indians, NRIs, will maintain their balances in the foreign currency itself. Okay, in FCNR account, you can maintain your balance in foreign currency itself. And NRE deposit accounts. NRE deposit accounts are non-resident external account. In these NRE accounts, you need to maintain in Indian rupees. Okay. So, the eligible amount of incremental FCNR and NRE deposits of maturity of 3 years and above, the auditor should also verify loans out of FCNR deposits and interbank foreign currency deposits for reporting in Form A return. Banks should convert the foreign exchange assets or liabilities in USD, Great Britain pound, Japanese yen and euro into INR at RBI reference rate. Okay, you need to verify these calculations, whether these conversions have been done properly or not. And these FCNR deposits and NRE deposits, they should not be included in calculation of demand and time liabilities. Okay, see, this has been done in order to encourage the banks to accept these FCNR deposits and NRE deposits. As per RBI circular on maintenance of CRR or SLR or on foreign currency asset liability reference rate for INR or USD and exchange rate of other major currencies for conversion of foreign currency assets liabilities reference rate from FBIL should be taken. See, for the purpose of converting from one currency to another currency, the exchange rates that has to be taken are those exchange rates that are prescribed by FBIL. What is FBIL? FBIL is Financial Benchmarks India Private Limited. Okay. If reference rate is not available from FBIL, banks may continue to use newer closing rate for conversion of such currency into USD. So that is clear. And the auditor should also particularly examine whether the balances in branch adjustment account of foreign branch have been taken into account in arriving the net balance in branch adjustment account. Okay. The auditor should examine the correctness of data in Form A written for CRR and written in Form 8 for SLR purposes. Okay. These for purpose of CRR, you will furnish Form A, and for purpose of SLR, you will furnish Form 8 to RBI. Okay, whether these calculations have been done properly or not, you need to verify. As stated in preceding paragraph, considerable part of information required by the statutory central auditor for reporting on compliance with SLR requirements will flow from branches, right? These CRR and SLR, it will be calculated at the bank level, not at the branch level. Okay, so central statutory auditor will calculate this, and the information for calculating CRR and SLR, it will be received from the branches, right? So it is suggested that the relevant information pertaining to branches within a region may be consolidated at regional level. The auditor of the region concerned should verify the same in the manner described in above paragraphs and report on the same. The consolidated statement should also be countersigned by the regional manager. Okay, since the data with respect to these CRR and SLR will be collected from the branches, what they are suggesting is branches of a particular region, they have to collect all the data from those respective branch, and the regional auditor, he needs to once verify that data before sending it to the central statutory auditor. Okay, the auditor at the central level should apply the audit procedures listed in above paragraphs to the overall consolidation prepared for a bank as a whole. Where such a procedure is followed, the central statutory auditor should adequately describe the same in his certificate. Okay, all the procedure that has been described for verifying the calculation of CRR and SLR is there now, that has to be done by regional auditor also before forwarding the data to the central statutory auditor. Okay, before forwarding the data to statutory central auditor. Okay, where such a procedure, if the bank follows such a procedure, the central statutory auditor should adequately describe that procedure, that this procedure has been followed in his certificate. Okay, in his certificate he has to mention that this procedure has been followed. Okay, so that is the amendment in the audit of banks with respect to CRR and SLR requirement. Okay, so if you see in professional ethics, the amendment is with respect to the CA logo. New CA India logo has been introduced now. The amendment is with respect to that. So if you see, guidelines issued in 2023 for using new CA India logo for CA members prescribes that logo consists of the letters CA in blue color with a tricolor tick mark upside down with a white background. Okay, earlier we used to have only one colored inverse tick mark, right? Now it is tricolor inverse tick mark. You can see the new CA logo. The background is white, the letters CA and India are in blue, and the tick mark colors are green, uh, orange and white, which represents our national flag. This is the new logo. And you should, the correct format of using the logo is this. You should not use the logos like this. Okay, you should not tilt it, you should not crop it. Okay, you should not rotate it, you should not rotate it like this, or you should not change the background, or you should not change any of the colors. You should exactly use it like this. Okay, and if you see, there should not be any alteration of the font color, bold, unbold or size. Moreover, there should be no change in spacing and dimension. The color palette is this. Okay, this is the color palette. Basically, for each and every color there will be a color code. Okay, this is the color code of our CA logo. And do not change the design and colors, including white background. Refrain from rotating or tilting. Logo should not be shrunk or distracted. Okay, while members are encouraged to use the new CA India logo as published on letterheads. Okay, you can use this new CA India logo on your letterheads, visiting cards, website, etc. And a transition time of 1 year has been provided to use the existing stationery signage replacement, etc. Okay, with the existing old logo, you can use the existing stationery and visiting cards for a period of 1 year. Okay, next, Ethical Standard Board has given some decisions, recent decisions of Ethical Standard Board. Let us quickly see them. First one, it is not permissible for member in practice being a statutory auditor to prepare business responsibility and sustainability reporting study to audit clients. See, a member who is in practice should not prepare BRSR report for his audit clients. Okay, we have seen in SDG and ESG chapter, there is this requirement of business responsibility and sustainability reporting for listed entities, right? Now that BRSR report should not be prepared by the auditor. Okay, auditor has to just give assurance on the BRSR report. That is the first decision. Next, statutory auditor of entity is not permitted to engage in assignment of compilation engagement of that entity as per SF 4000 SRS 4014. Okay, the statutory auditor of the entity should not provide compilation services to the entity. Okay, he should just provide audit services. Next, compilation means compilation of financial statements or preparation of financial statements, you can say. Next, it is permissible for members in practice to engage in services assessment, performance audit of centers of skill development council of Government of India. Okay, Government of India is having skill development centers, right? So at that skill development centers, the chartered accountants, they can perform performance audits. Okay, in audit of PSU we have discussed about performance audit. Okay, so auditors can perform performance audits of these skill development council of Government of India. Next, yeah, it is permissible for a member in practice to accept assignment of mystery audit. What is meant by mystery audit? Mystery audit means, let me give you an example. Let's say there is a bank. Now, in order to check whether bank branch is properly following all the procedures or not, auditor will visit the branch as a general customer. Okay, as a general customer, he will visit the branch and he will verify whether all the controls are properly being followed or not, and the customer service is being provided properly or not. So this type of audit is known as mystery audit. Okay, so it is permissible for members in practice to accept these mystery audits. Next, it is permitted for a member in practice to mention position as promoter director on the portal of a company. However, the member cannot mention his professional attainments and name of the firm with which he is associated. We already know that a member can act as director simpliciter of a company, but a member cannot act as managing director or whole time director of the company, right? Now, along with acting as normal director or the director simpliciter of the company, on the company's website, member can give his name as director of the company, but member should not provide any details of his practice. Okay. Next, it is permissible for a member in practice to become professional director in the board of management of cooperative bank. Okay, in the cooperative banks, the chartered accountant, he can become professional director. It is permissible. Next, it is permissible for a member to set up a practice in IFSC or gift city. Gift city is one type of SCZ for financial services. Okay, this gift city, first gift city is established in Gujarat. Okay, IFSC is nothing but International Financial Services Center. Okay, certain exemptions and certain benefits will be given for the businesses if they operate from this gift city or this IFSC area. Okay, yes, just a second. So the member can also establish his practice in this gift city or in the IFSC area. Okay, IFSC area is nothing but it is just like SCZ for financial service providers, like for banks, for stock brokers, for stock exchanges. The IFSC or gift city is like SCZ. You will get certain benefits if you operate from this gift city or from IFSC. Okay, just a second. Next, it is permissible for a member to render professional services to IFSC units from offices outside IFSC unit. Okay, from by establishing a office outside of IFSC, you can provide professional services to the companies operating in IFSC. Okay, IFSC means International Financial Services Center. Next, a firm is not permitted to publish its vision or mission statement on letterhead, visiting card, or stationery. Okay, the CA firm, it cannot publish its vision and mission on the letterhead, visiting card, or stationery. The vision and mission statement may be printed on firm profile and may be provided in response to a specific request. Okay, you can print your mission and vision in the profile of the firm, and if any person asks your profile, then you can give it. Hope that is clear. It is not permissible for member or firm being the statutory auditor of a bank to accept the assignment of ASM of a customer of the same bank simultaneously. Just a second, sorry. What is this ASM? ASM means annual stock audit. Generally, banks, they will conduct stock audit of their borrowers. Okay, bank will appoint an auditor on behalf of bank, and it will conduct audit of their borrowers. Annual audit they will conduct, right? Now the person who has taken statutory audit of a particular bank, he should not simultaneously take annual stock audit assignment from such same bank. Hope that is clear. You have to take any of the one. You have to take either statutory audit of the bank or stock audit assignment from such bank. Hope that is clear. Next, a member in practice cannot be appointed as internal auditor and procurement officer simultaneously in an organization. Okay, in an organization, you cannot act as both internal auditor and procurement officer simultaneously. You can be either of the one. Okay, next, it is permissible for member in practice to charge fees on a percentage of utilization amount of educational institution for certifying the amount utilization spent by a educational institution out of a grant. Generally, educational institutions, they will receive grant from government. Now in order to verify whether this grant has been properly used for the specified purposes or not, the respective person or the government who has issued the grant to the educational institute might ask a certificate of utilization of amount from a chartered accountant. So then this educational institution will ask the chartered accountant to give a certificate of utilization of the funds, stating that the educational institution has utilized these funds which has been given to it as a grant properly for the specified purposes only. Like this, a certificate has to be given by the chartered accountant for the educational institution, right? Now for giving such a certification, chartered accountant can take fees on a percentage of utilization of amount. Okay, if let's say CA is giving certificate of utilization of 100 crore fund to institute to the educational institution, then he can charge 1% fee, or he can charge 0.5% of that particular amount. So percentage of fee can be charged if you are giving the certificate of utilization of amount to the educational institution. Okay, these are the 12 latest decisions that has been given by the ethical standard board. Hope that is clear. So these are the amendments with respect to audit for May 2025 examination. Hope that is clear. And an important announcement for you people, we have recently launched Lecturepedia app. You can download this Lecturepedia app from Play Store, and on this Lecturepedia app you can solve MCQs of all the subjects, okay, at CA final level, inter level, and foundation level. Okay, all the MCQs of all the subjects of all the levels you can solve. Not only CS students, even CMA students and CS students can also solve MCQs on this Lecturepedia app. Okay, apart from solving MCQs, you can also purchase courses of various topmost faculties on our Lecturepedia app. Okay, you please download our app from Play Store and do check out it. Okay, we'll be meeting in the next video. Until then, take care. Bye bye. See you.